We just experienced one of the best two-year stretches for markets in history.
All the positive news is priced in.
It's hard for me to be negative U.S. equities.
The U.S. growth situation is in pretty good shape.
I'm looking for a bumpy year, and a lot of those bumps are going to be occurring over the next few months.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Monday, looking to build on Friday's gains with equity futures on the S&P 500 higher by 0.4%, on the Nasdaq 100 up by 0.7%. Check out the bond market and have a little look at the long end of the curve. The 30-year yield in America hitting the highest level since 2023, up a single basis point to 4.83. Going into a major week ahead with tons of economic data, concluding with payrolls on Friday. Before we get to payrolls on Friday, though, we need to talk about some debt auctions in America. Carrying just a little bit of weight this week, $119 billion of debt sales, a 3-year today, Bramo a 10-year tomorrow, and a 30-year on Wednesday.
Yeah, brought forward because of Thursday, the holiday in terms, or the day off for Jimmy Carter's funeral. A real question here about what the signal from the yield rise is. Is it the anticipation of $119 billion of debt sales? Is it the anticipation of an agenda from President-elect Donald Trump, who potentially could deepen the deficit? Or is this a signal of just normalization that's positive because we should have a disinverted yield curve?
Well, I think it tees up the perfect conversation that we've got to have this morning. Speaker Johnson looking to hit the ground running. One big, powerful bill, and looking to pass that bill by April.
They want to get this one big reconciliation bill out of the gate. There's been lots of ooh and ahhing on this program between Republicans within the House and the Senate, how they would go about enacting President-elect Trump's agenda. Would they do one immigration bill out of the gate, as Senator John Thune wanted to do? Or are they going to do what Jason Smith of House Ways and Means has been pushing, one massive reconciliation bill? President Trump made it very clear yesterday in a post. One powerful bill, immigration, energy, and expanding tax cut. He made a point to talk about no tax on tips.
Basically, all of this is coming down to the question around deficit anxiety. And ultimately, from a market perspective, there is a real anxiety right now about how much momentum they have to actually do cost cutting to offset some of the deficit expansion that a lot of people at this point are just penciling in.
Morgan Stanley's Mike Wilson talking about this morning to kick off the week in his notes, saying that rates are the most important variable to watch, that in early 25 already we're seeing the correlation of equity returns to bond yields decisively negative. We heard from Priya Misra of JP Morgan last week talking about this, reflected on what Max Kettner of HSBC had to say, that rates have decisively moved into what he believes is the danger zone.
There is an alternative. I mean, if you just think about it from an investment perspective, and then you take a look at some of the areas that people say have been the cheapest, they are the most leveraged to rates remaining low. A key question here as we move forward is today is actually a great test. Can you eke out gains at the same time that the 30-year yield's the highest level going back to November 2023, when you have a yield curve that is the most positive from 30-year to 2-year going back to 2022?
Bonds down, yields up this morning by a single basis point on a 30-year, up by close to 2 on 10s, 461 on a 10-year yield. Coming up this hour, we'll catch up with Calvasina of RBC on her favourite sectors for the year ahead. Terry Haines of Pangaea Policy as Johnson pursues Trump's agenda. And Jane Foley of Rabobank as the dollar pulls back from 2-year highs. We begin this hour with stocks rising after snapping a 5-day losing streak on Friday, getting a boost from big tech. Calvasina of RBC keeping a close eye on the sector, writing, "We remain market weight, S&P 500 tech, our favourite S&P 500 sectors heading into 25, are financials and energy, along with communication services." Laurie joins us now for more. Laurie, good to see you.
Good to see you too.
Good morning. Let's talk about the year ahead, and not just the sectors. Let's talk about policy. Have we got a better idea of what policy and how it will be pursued will look like down in Washington, D.C.?
I don't think we have it yet. I think that we're optimistic we're going to get some clarity soon. And, you know, chatting with Emery earlier about the one big powerful bill, I instantly thought back to my European meetings in December, right before the holidays, when I was kind of doing the death march across the continent. And, you know, in every single meeting, people wanted to talk about taxes and tariffs and what exactly is Trump going to do and when are we going to know? And, you know, I had to sit there and tell them, well, I think we got to get past the inauguration first. But if you go back to 2018 or actually 2017, what I remember about that tax bill, I'd moved firms and I was trying to put out a forecast and I kept having to change my earnings estimate because the tax rate kept changing. I think like literally up until like the week they passed the bill, and it was driving me absolutely mad. So I kept coming back to that that anecdote. But the reality is markets did price in a lot of the good stuff ahead of time anyway. So I think just the promise of getting some clarity sooner rather than later, and frankly, just ripping off the Band-Aid, right, and getting a lot of this stuff done all at once, I think that's good for markets. I think one of my core beliefs about politics and markets, whatever it is, you have to go through some temporary repricings, and those can be painful for the markets. In some instances, those can be painful for certain sectors. Sometimes they're not. Sometimes they're good. But whatever it is, it tends to be rather short term. The market reprices, and then you move on.
Something we talked about last week coming into this week, and you mentioned 2017. Do you believe we're coming into something that looks like 2017 or something that looks like 2018 or something very different?
I think it's a combination. I think there's some rhyming and some echoing that's going on. But what I do remember about 2017, again, was that we didn't even know what the tax rate was going to be for corporations, and we managed to price it ahead of time anyway. And, if you look back at sort of that big move we had over the summer when the market started to sniff out the Trump victory into the November highs, I think markets were kind of baking in a lot of the good stuff, right? And maybe a lot of the challenging stuff still needs to be filtered in. And in the prior, administration, right, Trump version 1 was kind of the good stuff in 2017 and the challenging stuff in 2018. And I think that's all been kind of pulled forward. But there was sequencing, and maybe we're just not going to do that same sequencing. We're just going to do it all at once, and the market can have a better picture of how it all fits together. And then we can move on to whatever's next. But I do think, yeah, there's some rhyming, but I just do think the timeline is a bit different in here.
My head's kind of spinning. It always is when I talk about potential policy, especially at a time of incredible volatility and some contradictory messages. I wonder how much policy is going to drive the returns outlook versus the bottoms-up estimates that you're looking at in terms of earnings from companies that have seen a really good period but seem to be facing a bit more of a challenge.
I always say when we're in these periods, my head's twisted into a pretzel, and I definitely felt like that a little bit at the end of the fourth quarter. But I think you're right. I think it's all about the transmission mechanism to earnings. And what are some of those other transmission mechanisms, right? One is the tax rate, right? And even though it seems, maybe kind of artificial, right, investors will still cue off what the actual earnings are. Another transmission mechanism, right, is going to be the read through to the vibes. Corporate sentiment, investor sentiment, looking at things like the Michigan consumer survey that's coming out later this week. So I think those things all show up in the earnings at the end of the day. But I do think, kind of going back to that interest rate conversation earlier, I think that's another transmission mechanism that matters a great deal. And I kind of agree with the danger zone comment. I mean, I don't think we're quite there yet, but I think 5% is a problem for this equity market if we get there.
This is where I wanted to go. This question of how much policy and some of the more stimulative aspects are going to be the driver versus this. Strong dollar, higher yields. The strong dollar already reducing some of the international presence of companies. How much is this being accounted for, and how much do you think that this market is really at the precipice of a bigger decline if we do reach that danger zone?
So if you just want to take the dollar, for example, it's been something curious happening recently, which is we've only kind of recently started to see downward revisions to bottom-up consensus estimates. And normally when you're in this big period of dollar appreciation, you would have seen that a bit earlier. And it's starting to show up in my data now. So I think we're going to have to work through that. I think that's temporary. I don't think that derails the market as a whole. But I do think if we see the 5% on the 10-year Treasury yield, what I'm seeing in my earnings yield gap modeling right now is that if we hit that 5% number, we're going to flip the earnings yield gap into a range that's typically followed by equity market declines on a 12-month forward basis. So we can sort of hang out in 4.6, 4.8, but if we hit that 5% and you don't see a big improvement in the earnings yield, it's going to be signaling a problem. And I think the other problem with 5% is, and look, I'm not a technician, I'm not a rate strategist, I just look at the charts, right? And if we break through that 5%, I think I'm going to have a lot of equity investors saying, are we in a structurally rising rate environment, which will be a tremendously different thing than, any of us have really seen in our careers. We're sort of chopping around right now, but most of my career we've been in the structurally declining environment, and I think that's where the muscle memory is.
We've got to talk about tariffs as well. This breaking from the Washington Post just now. I'll share the lead paragraph with you. President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country but only cover critical imports. This according to 3 people familiar with the matter.
So what this says to me is that this is going to be a more narrow-looking approach when it comes to the tariff regime. And further down in the story, they talk about things that are critical to national or economic security. So Lori, when you see stories like that, and you start to get some color around what this tariffs could mean, and yesterday in Trump's tweet about the one powerful bill, he said all will be made up with tariffs.
Yeah.
Is that enough to pay for this?
I don't know. And look, I think they're trying to do this right through the reconciliation process. So, and I'm a little fuzzy on how all that works. But I think that sort of reduces, right, what they can ultimately do in terms of tax cuts, because they've got to make everything balance out. So, I think on the one hand, the markets will cheer a narrower approach to tariffs, more targeted. There's been a real concern over the last 6 weeks or so that the market has not been baking in a broad-based kind of tariff approach. On the other hand, are you really going to get, anything much more than a renewal of existing tax cuts, right? Is it keeping tax rates low, or is it getting a bunch of new cuts? How are you going to get a bunch of new cuts if you don't have a lot of new revenue coming in?
When you look at how potentially tariffs might impact earnings, what sectors do you think would be the best in terms of making sure that they're the ones that are less vulnerable to potentially some of the retaliation we could see in the tariff space?
It's going to depend on what's on that list at the end of the day. But if you look back at 2018, the two sectors that really got smoked were industrials and materials. And so I've actually been sort of debating the industrials. There's a lot of enthusiasm on industrials in the States, not so much in Europe and Canada. And I think when I've talked to some of the domestically based investors, they've assumed that this whole reshoring is going to benefit especially small and mid-cap industrials. And I'm like, well, let's just hold up. We're trading at 3 standard deviations on valuations, and we're also looking at a sector that was really at the epicenter of these tariff issues the last time around. Defensives did best last time, right? It was things like healthcare, consumer staples, utilities, REITs. REITs and utilities came up a lot in my European meetings because they just don't seem affected either way.
Well, speaking of Europe, headlines like these will open the door to have conversations about whether this allows people to think about international equities just a little bit more. The fear ahead of these headlines was a universal tariff as high as 20% on everything that America was importing. Lisa, when you see headlines like this and then look at foreign exchange, just a bit more euro strength, just a bit more strength in the Mexican peso, it's marginal stuff, but it starts a conversation.
Well, it starts a conversation about what the purpose of tariffs will be. Will it be to sort of jawbone or give some sort of increasing momentum to the American exceptionalism story, or will it be very targeted for either national security reasons? These are key issues like critical supplies like steel, iron, aluminum, copper, syringes, needles, batteries, rare minerals. There's a real question here about if these are targeted to national security and specific needs, they won't have as big of an effect on Europe, because strategically it would make sense that they would not necessarily be as included in some of these.
Two things also come to mind. How much pushback will there actually be from Democrats? Because this has been their whole approach as well, especially when you think about going after China. It needs to be narrow, needs to be specific. Also, is this because the Trump incoming administration is concerned about higher inflation? So they want to take a more targeted, slow-going approach when it comes to tariffs.
We should stress that no decision has ultimately been made. This is the latest reporting from the Washington Post. Laurie, it's good to see you, to catch up on a whole range of things going into the next year and beyond. Laurie Calvasina there of RBC. If you are just joining us, this from the Washington Post just minutes ago. President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country, so universal tariff, but only cover critical imports. This according to 3 people familiar with the matter. More on that a little bit later. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Staying in D.C., Congress is set to meet today to certify President-elect Donald Trump's election win. President Biden invited a group of new Democratic lawmakers to the White House last night, urging them to commit a peaceful transfer of power. As Trump prepares to return to the White House in 2 weeks, expectations are high that he will give swift clemency for the 1,000-plus people convicted and hundreds more with pending cases related to January 6, 2021's insurrection. Meanwhile, in Canada, Prime Minister Justin Trudeau is said to be preparing his announcement to resign. The Globe and Mail newspaper says the announcement could come as early as today. It would trigger a race for the party leadership, with the winner becoming PM. Trudeau has been under pressure from lawmakers in his party to quit for months. Scrutiny grew last month after his finance minister, Chrystia Freeland, quit. People familiar say that Italy is in talks with Elon Musk's SpaceX for a $1.6 billion deal, providing encrypted telecoms for the government over the next 5 years. The negotiations appeared to move forward after the Prime Minister, Giorgia Meloni, met with Donald Trump at Mar-a-Lago. Some Italian officials, though, are concerned about the deal's impact on local carriers. It has, though, been approved by Italy's Intelligence Services and Defense Ministry. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, one big, beautiful bill.
President Trump is going to prefer, as he likes to say, one big, beautiful bill. And there's a lot of merit to that because we can put it all together, one big up or down vote, which can save the country, quite literally. We're targeting a vote in the House, it may be in the first week of April.
That conversation up next, live from New York City this morning. Good morning. Foreign exchange waking up to some headlines already Monday morning. Check it out. Euro-dollar session highs approaching 104 all over again, 103.89. That's some euro strength, and that's rare over the past month or so. Check out dollar peso. Some Mexican peso strength as well in the mix. Dollar Mex near session lows. We're negative about 0.5%. So once again, a stronger peso, a weaker dollar. All of this building in the last 10 minutes or so. Off the back of this headline from the Washington Post, President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country but only cover critical imports. This according to 3 people familiar with the matter. Now, no final decision has been made, but certainly some early murmurings that maybe some of the campaign promises might be, I stress might be, watered down.
There was a lot of preparation for an opening salvo that would be potentially pretty big and potentially pretty damaging should it go through in terms of huge tariffs on the likes of Mexico, on Europe, and of course on China. The fact that the opening salvo is targeted is definitely sending a signal that's being heard in foreign exchange.
A warm welcome to 2025 because this move can be undone just like that by a single post from the incoming president. So stay tuned. Under surveillance this morning, one big, beautiful bill.
We're 15 days out from the inauguration of President Donald J. Trump for his second term, and we want to make sure that we're jump-starting the agenda now over the next 2 weeks so that he's prepared and ready on day one. President Trump is going to prefer, as he likes to say, one big, beautiful bill. And there's a lot of merit to that because we can put it all together, one big up or down vote, which can save the country, quite literally. Reconciliation is the way to get it done. Why? Because you avoid a 60-vote threshold in the Senate. We're targeting a vote in the House, it may be in the first week of April.
So here's the latest this morning. House Speaker Mike Johnson laying out an aggressive plan to pursue President-elect Donald Trump's agenda. House Republicans aiming to pack his priorities into a single bill and pass it by April. President-elect Donald Trump posting this: Republicans must unite and quickly deliver these historic victories for the American people. Get smart, get tough, and send the bill to my desk to sign as soon as possible. Terry Haines of Pangaea Policy joins us now for more. Terry, on this bill, how big is it going to be and how quickly can they pass it?
The short answer, John, is I have no idea, and it's going to take a really long time to figure that out. Markets, I know, are slavering for clarity. I wrote a lot about that yesterday, but I would urge people not to engage in premature clarity on this, generally speaking. Speaker Johnson is doing exactly what he has to do. The market signal is from Washington is we're serious. We're going to work on this as hard and as quickly as possible. That's all very good. The political signal is that, you know, the House always overcooks everything. So what you want to do is, you know, kind of overreach, and then you get pulled back in by the Senate a little bit. Number one. Number two, what Johnson's doing is engaging in the care and feeding of the other branch of government here, the executive branch. Trump just helped him become speaker again with a minimum of fuss. It behooves him for political and policy reasons, both to try to get as much as possible, as quickly as possible, and also agree with Trump right now. The reality is that Johnson doesn't have everybody in the House on the one big, beautiful bill strategy. And more importantly, he doesn't have the Senate at all. So we're a long way away from determining what's actually going to happen.
Terry, over the weekend, Senator Thune, Senator Lindsey Graham, we're still all talking about one bill coming out almost immediately on immigration and then doing taxes. So are you saying that markets need to be prepared for potentially going back to 2 reconciliation paths?
Yeah, I am. I'm fundamentally what I'm saying is that the path here is not at all decided, and it's not all going to be decided for quite a long time. I've tried to summarize the politics and the market signals in my last answer. Here, what I would say is that they've got a lot of barriers to jump over before they get to the size of the one big beautiful bill. You've got debt ceiling, debt limit that they need to decide upon. Trump has to provide a budget. You've got a situation where you've got to figure out then the size of the deficit. And markets, frankly, are going to have a role to play here, as you all were talking about earlier, and Bloomberg is reporting. The way that the way markets are reacting to increased deficits and the like, particularly in the bond side, may result in pulling back some of the more extreme wishes of Johnson and the like.
I want to put two of these stories together. One, what Trump came out in black and white and said about this one powerful bill. He said it'll all be made up with tariffs. And then this morning, we get a story from the Washington Post talking about tariffs that look to be more narrow in nature. How are they going to pay for all of this if they're more narrow in nature, focused on national and economic security concerns?
Well, the answer is they don't know. And, what I can tell you is that another thing for markets here is that, 2017 is not like 2025 for Washington or for anybody else. This is obvious on one level, but it affects the size of additional deficit. It affects like how many pay-fors they're going to have and what they are, and all those decisions are months away. So the idea, Johnson, I think, is exactly right in trying to be as clear for markets and politically as possible. But at the same time, all these hurdles and markets' reaction to how these folks get over these hurdles is going to determine a lot of the size of the tax cuts and exactly what they decide to do. The last thing I would say about this is that Trump is going to ramp up defense and defense industrial base spending and supports, and that's going to have a piece to play here too.
I am wondering, just to build on what Anne-Marie was talking about, your take on this headline from the Washington Post about universal tariff plans with one key change, the key change being that it only goes after certain key imports, including things like steel, iron, aluminum, copper, syringes, as well as batteries and rare earth minerals. Do you think that this is a sign that this administration is going to take a more targeted approach with potentially national security in consideration more than, say, 100% tariffs on everybody unless they come and kiss the ring?
I think it's another sign of that, Lisa. My view of this all along, watching these folks closely and what they do and what they say, has been that, markets have veered back and forth between saying this is all negotiation versus, the tariffs will be all about application. The answer is it's not going to be one or the other. It's going to be a mix of both. It's going to depend on, kind of which products, and it's going to depend on which countries. And I think you can vector it out from there.
Terry, good to hear from you, sir. Busy morning already. Terry Haines there of Pangaea Policy. Check out euro dollar, a move of more than 1 full percentage point now. Back through 104 on the euro. Could be, possibly, the biggest one-day move for the euro going back to the summer of last year. Off the back of this headline from the Washington Post, the consideration at least of watering things down a touch.
Yeah, watering things down and going after key supplies, most of which come from China. And let's be very clear, this is not the type of imports. The U.S. isn't importing a dramatic amount of syringes from Germany. This isn't a question of that. This is coming from China, so it's going after a very targeted group, basically alleviating some of the concerns that Europe had.
One thing that's very clear to me this morning, whether or not it's the Washington Post reporting or what Terry Haines just said, the markets will have a voice in the policy that this incoming administration dictates, whether it's not those concerns about tariffs or whether or not it's how big they can really squeeze into this one or two packages of reconciliation and how willing they are to add to the fiscal deficit.
This is why so many people have come on the show going into 2025 saying brace for volatility. Everything we're talking about right now can be undone with a single post from the incoming president of the United States. And we should stress repeatedly, every time we reference this story from the Washington Post, that no final decision has been made. It speaks to considerations taking place within the Trump administration as they go into power over the next several weeks. And Lisa, things can change very quickly in the next several seconds when the president wakes up.
It's the point that Stuart Kaiser has made that you've referenced earlier. Are we heading into 2017, which was a low volatility, big risk asset gain? Or are we heading into 2018, which was high volatility, low returns?
More on this story in just a moment. Up next on the programme, Leland Miller of the China Beige book. From New York, this is Bloomberg. Snapped a 5-day winning streak, or rather a 5-day losing streak on the S&P in Friday's session, and we look to add some weight to it this morning. On the S&P, we're up by 0.6%. On the Nasdaq 100, up by 1 full percentage point. On the Russell, up by 0.7. Some moves in the bond market to talk about. On a 30-year yield, up by a single basis point or so. A 30-year yield now the highest, going all the way back to late 23. We're through 480. Just a range of commentary coming from the south side on all of this, including this from Mizuho's Jordan Rochester this morning. US data surprises may have finally stopped falling after strong claims in ISM manufacturing last week. Combine that with Trump's fiscal plans, it's why 5% is more likely than 4% on US 10s. Right now, the 10-year just south of 460, 459. We've got to talk about trade and foreign exchange. This headline coming from the Washington Post just moments ago, that President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country but only cover critical imports. This according to 3 people familiar with the matter. Off the back of this, look at this move in foreign exchange. Up by 1% on euro dollar, 104. Some strength for the Mexican peso, likewise for the Chinese currency. Big headline 30 minutes ago.
It's a big headline, and you rightly point out the volatility that this introduces. If this headline is what actually is going to come to pass, then it is a slightly dollar negative, but really a positive for the rest of the world, particularly Europe and Mexico. If this is just some of the noise that we can expect to hear, it really speaks to the question of how much volatility some of these headlines are going to really introduce.
And it's true and smart and prudent to talk about the fact that this could just be noise. These conversations are happening in Palm Beach right now, and they will continue to happen. And President-elect is just that, President-elect. He will take office in 2 weeks' time, and then potentially we'll see exactly what the policies will be. But what this is signaling to the market is that those ideas of blanket tariffs that ring around the United States, potentially that's out the window, and this will be a more targeted approach.
Let's see. Let's see what the incoming president's got to say. As far as this market is concerned, inauguration took place in early November. Equities are up. Bond yields are a little bit higher at the long end, and the dollar's a touch weaker on the session so far. Under surveillance this morning, the Globe and Mail reporting Canadian Prime Minister Justin Trudeau is likely to step down this week. The resignation expected to happen before a key National Caucus meeting on Wednesday. This coming after months of pressure from his own Liberal Party to resign. His party 20 points behind Conservatives in the nation.
Yeah, this is sort of not only widely expected, but basically the question has been who takes over and how soon will he resign. Of course, some of the caveats in the non-source story says that he hasn't completely decided. There is a bigger takeaway here, and this is a shift to a more conservative approach globally. This comes with the threat of, yes, Donald Trump, but it also comes with something that has happened structurally. And I think about what's going on in Canada with the Liberal Party really underwater politically, but I also think about what's happening in Austria. I think about what's happening in Australia, and I wonder how much they're prepared for that.
It doesn't really matter if Justin Trudeau has made up his mind. He's hanging on by a thread. 20 Liberal members of Parliament have publicly come out and said, this is enough, you need to step aside. Even more of them when you start taking into consideration what they're saying behind closed doors. And I go to this one member who said, simply put, time is of the essence, adding that it's not tenable for you to remain as leader. Why? Because they're concerned about the economic threat coming from the United States, and they need to be prepared for that, not hanging around with this lame duck prime minister.
You know when you see CEOs get fired at the stock rallies, how embarrassing is it for Justin Trudeau that he's talking about a conversation's happening about him resigning and the currency's rallying off the back of that? What does that tell you? That's like the CEO story on steroids. That's shocking.
I would argue that the embarrassment's been going on for quite a while with some of the stories and some of the internal dissent, even from his own party, nonetheless, the finance minister. But yes, there is a real question here. How quickly can they get certainty? And will he allow that process to start sooner rather than later?
Speaks to what investors think is good for the country right now, that's for sure. Let's turn to Italy. Italian Prime Minister Giorgia Meloni meeting with President-elect Donald Trump at Mar-a-Lago over the weekend. A person familiar with the matter telling Bloomberg the two discussed a wide range of topics, including tariffs and the arrest of an Italian journalist in Iran.
So these were the two main topics on this list. And it wasn't just President-elect Trump that was there. Treasury Secretary Scott Bessent was there. Incoming Secretary of State Marco Rubio, his national security advisor, was there. So you can see, based off the people in the room, what was likely going to be discussed with Giorgia Meloni. I will say, for Giorgia Meloni, this was politically a very smart move. President-elect Trump is likely going to bash a lot of European leaders he invited to inauguration who decided not to come. She got ahead of that. At the same time, she's able to also stay away from the inauguration and likely show Ursula von der Leyen and other members in Brussels that she could be the main voice and conduit to this incoming administration.
For a long, long time, we had US presidents talking about, I don't know who to call. When I call Europe, who do I call? I think now when you call Europe, you call Giorgia Meloni. That's the face of stability in Europe, and there isn't much stability elsewhere, that's for sure.
How do you think Germany feels about that? That the face of Europe and the face of stability is the Italian prime minister at a time when it's unclear who is exactly going to be the ruling party.
Well, exactly. Who's going to be the face of Germany? What does the future look like in France, let alone what is going on in the United Kingdom? One thing is for certain, Giorgia Meloni is sticking around. And it was so apparent, we talked about this a few weeks ago, at that G7 meeting. She was the standout, the only one that was likely going to be left amongst all those leaders.
So Joe Biden is still the president, just to reiterate that. And his latest decision has attracted some controversy. Shares of Nippon Steel sliding after President Biden blocked the company's planned takeover of US Steel. The two companies describing the decision as political, saying in a joint statement there was no evidence of a national security threat and they intend to challenge the order. This came from Richard Haas, posted on X over the weekend. The decision to block Nippon Steel and the purchase of US Steel is bad economics and foreign policy, both. It threatens jobs here, encourages protectionism elsewhere and undermines what has been a defining alliance-first approach to the world. It's a stain on Biden's legacy.
It also politicizes CFIUS, which many in the markets have trusted for this is going to be serious when it comes to deals that are being done and actually protecting the U.S. from national security concerns. We do know that Nippon Steel, according to local press in Japan, will have a press conference tomorrow. And the Wall Street Journal, based on what Richard Haas was saying and also based on some of the conversations I've had, gets to the point this morning about that push and pull between Biden's domestic advisors concerned about those union jobs in Pennsylvania versus those like Secretary of State Antony Blinken and Jake Sullivan, his national security advisor, on the fact that actually you might be damaging relationships when it comes to Japan. If you're a Japanese company, how are you thinking about potentially investing right now into the United States?
On the way out the door. And that list of people, very long. Let's turn to China. The country's central bank reaffirming its support for the yuan, setting a stronger daily reference rate and planning to sell more bills in Hong Kong to help stabilise the currency. Investors remaining cautious due to China's sluggish economy and the threat of higher US tariffs. Leland Miller of China Beige joins us now for more. Leland, Happy New Year and welcome to the programme, sir. Last week, Lisa and I were talking about whether China would look to embrace the weakness of the currency to offset the threat of tariffs. Are you seeing signs that maybe point to the opposite?
No, I think it's too early to tell. I mean, I think if China has a plan to use the currency to push back on tariffs, it's going to wait until tariffs are in play before it does that. There's weakness in large part because the dollar is super strong right now. Everyone looks at Trump's plans for 2025. They see a stronger dollar there, too. So right now, this is mostly a strong dollar story. Of course, the yuan, they're going to be moving it around based on what they think they need to do. But this is actually an expectation of what Trump policy will be. That will move it, not try to get in the right place before Trump gets into office.
And just to sort of broaden out, Leland, how much are the Chinese authorities preparing for what Trump is going to do with the idea of a bazooka versus other measures that we're already seeing with cybersecurity issues popping up all throughout the government as well as telecom companies in the U.S.?
Look, markets love the idea of bazooka because it makes problems go away. The Chinese are not looking at a bazooka unless things absolutely fall apart. And one of the things that we've been stressing over the last several years of China Beige Book data is, yes, you've got a very weak economy. Yes, the Chinese economy has got plenty of problems, but that it's not collapsing. It's not in dire straits. So in a most extreme, China tariff scenario, you could certainly see the Chinese leadership wanting to go bigger in a way they haven't for a long time. But I don't think they're anticipating doing that. I don't think that's likely to happen in the near term. And so at this point, a lot of what we're looking at right now is the Chinese economic leadership getting ready to react to what they see. But bazooka's stretching it a bit.
Leland, just to sort of pull this together, is it fair to say that Chinese authorities are not as interested in propping up the economy? Yes, maybe putting a floor under how far GDP can fall, but not necessarily propping it up, as they are countering in an offensive way some of what the U.S. may be trying to do.
I think that's exactly right. And that's what markets, again, continue to get wrong on this. Back in the old days, we know that Beijing loved to see high levels of growth. They said, look at our leadership. We're great because we're making you rich and we're delivering high levels of GDP. That is not the way the Chinese economy runs anymore, and it's not the way that Xi Jinping thinks. What they want to do, if they have more economic problems, is counter that with some stimulus that will stabilize the economy, put a floor on the economy. But they're not reaching for higher growth. They are not reaching for the old stimulus playbook. What they want to do is make sure that the economy is not doing too poorly. It doesn't have a doom confidence loop where everything is sort of spiraling downwards off itself. And they can focus on what they really care about, which are national security priorities, not high levels of growth.
Speaking of national security, Leland, I know you've written a ton about the tariff approach the incoming administration is going to take on China. Well, this morning, the Washington Post is saying this is going to be only covering critical imports. You talked about the two approaches, which seem to be much higher and broad-based than just critical imports. What do you make of this latest reporting, and what is it telling you about what the incoming Trump administration may levy on China?
Well, this is sausage being made. So you've got two issues. You've got the China tariffs, and separately you've got a discussion of global tariffs. Global tariffs were never going to be levied. Here's one rate, and that's it. You're going to always have exemptions. If it was a 10% global tariff, you have to have a certain number of exemptions. If you have a 20% global tariff, you'd have to have enormous exemptions. So what the approach is that it's reflected in the Washington Post is that they're saying, okay, well, instead of starting with a base tariff rate and saying we're going to just chop out exemptions here, we're going to talk about a handful of sectors that are going to get this global tariff rate, and then we're going to add on to that as we think we can get away with. But a lot of this is simply the approach, and a lot of this is what happens when the transition becomes the administration, and you've got all these economic officials who weren't counseling the president before saying, no, wait a second, we've got a different approach on this. So I think that this is actually still a work in progress.
How much of this is national security versus actually deal making?
Well, there are certain things that are deal making. When you look at what the tariffs threatened on Mexico and Canada, for instance, these are sort of a threat. Take care of the fentanyl problem, take care of illegal immigration, or else. When you look at China and you look at it to some degree the global tariffs, this is about the idea that the huge U.S. trade deficit is a national security issue. It needs to be dealt with. Bilateral trade deficits are problematic with China. Global trade deficits are problematic because they have it's a pushback on American workers. So I think right now a lot of this is extending beyond deal making. There's also an issue with tariff revenue being used as a pay for the tax bill, which they'd like to do. So I think the broader takeaway here is that markets have been sort of underestimating how much the Trump administration likes tariffs as more than deal making. They see it as something structural they can use to restructure the domestic international economies. I think we're going to be seeing a lot more tariff talk than the street has been expecting.
Leland, and I'd love to finish on the domestic economy in China, just away from the tariff story, and think about international brands. Autos, luxury brands, foreign brands are looking for a cyclical upturn in the economy, looking for any kind of green shoots, a bounce, if you will. Are you seeing signs of them suffering from just a cyclical downturn, or do you think there is a real shift towards national champions away from foreign brands?
Well, we've been seeing a structural slowdown for a long time now. It doesn't mean that as you provide more help to the economy, you can't see some cyclical upticks, but that's not what we've been seeing. What we've been seeing is that manufacturing for a couple of years has been the growth leader. Exports. They're under extreme pressure right now and will be even more so in 2025 because of trade frictions. We have not seen a bounce in retail and services. They're still doing quite poorly, even after this, supposed mega stimulus that was supposed to have come at the end of September. So enormous pressure on domestic demand. Not a lot of reason to believe that this is going to turn up unless you're one of the people who still think that China is going to push that button, get that bazooka, restructure the economy towards domestic consumption, and all will be well. But obviously, China Beige Book is not in that camp.
Those people do exist, Leland, beyond China Beige Book. They're not going away. Leland, appreciate the clarity. Thank you, sir. Leland Miller there of China Beige Book. The latest on over in Asia. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. We begin with that breaking news from earlier in the hour. A new report from the Washington Post suggests that President-elect Donald Trump is exploring a universal tariffs, but they would only cover critical imports. 3 people familiar with the matter told the Post that Trump's aides are still discussing the plan on imposing duties on every country. It would be a paring back of the most sweeping plans from Trump's 2024 presidential election. In a rare Sunday ceremony, President Joe Biden signed the Social Security Fairness Act to increase Social Security benefits for over 2.5 million retirees. The bill changes the formula that had been used to reduce benefits for certain beneficiaries, like those on government retirement plans, including police officers, firefighters, and teachers. The law is expected to boost Social Security payments by an average of $360 per month. And in South Korea, investigators have asked the police to execute a warrant to arrest President Yoon. The court-issued warrant is set to expire by the end of today. Investigators' initial attempt to arrest Yoon last week was unsuccessful and led to a standoff with his security team and thousands of supporters. It's still unclear whether or if a second arrest attempt may take place. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, the dollar rally taking a breather.
It's not just about better growth in the U.S. It's also about the U.S. asserting itself geopolitically and strategically. Of course, this is good for the dollar. People want to be in strong countries, not strong economic countries, but strong political countries as well.
That conversation up next, live from New York. You're watching Bloomberg TV. Snapped a 5-day losing streak on Friday's session, looking to add to those gains this morning, up by 0.7% on the S&P. Some dollar weakness out there. Euro dollar 104 session highs are up by 1 full percentage point. Under surveillance this morning, the dollar rally taking a breather.
It's not just about better growth in the U.S. It's also about the U.S. asserting itself geopolitically and strategically. Of course, this is good for the dollar. People want to be in strong countries, not strong economic countries, but strong political countries as well. I don't think that the U.S. is trying to effectively dissolve the European Union or destroy Europe. It's maybe to weaken Europe, if only to strengthen it down the road by having Europe make that choice.
So here's the latest this morning. The dollar rally taking a breather after climbing to multi-year highs. James Foley of Rabobank expecting further strength in the future, writing the anticipation of pro-growth inflationary policies in the US had started to boost the greenback weeks before the election result was announced. We maintain a target of euro dollar at parity for Q2, that we realise the risk that this target could be achieved a whole lot earlier. Jane joins us now for more. Jane, welcome to the programme. I'd love, first of all, your reaction to the story that came from the Washington Post about 45 minutes ago, and I'll share the lead paragraph with you. The President-elect Donald Trump's incoming aides are exploring tariff plans that would be applied to every country, so universal tariff, but, and here's the key but, only to cover critical imports. This according to 3 people familiar with the matter. We've yet to hear, of course, from the incoming president himself on the record, and no doubt we'll hear from him later on today at some point on X or elsewhere on Truth Social. Jane, your reaction to that headline and how dependent your call is for euro dollar to get down to parity on what happens with tariffs?
Well, I mean, there's a couple of different ways to answer that question. I mean, the first thing and most obvious thing is that we don't know what is meant by critical imports. Is this food? Is this pharmaceutical goods, etc., and maybe a whole lot more. So it adds in a way to the uncertainties that we have. We've all been uncertain about the tariffs, how many or how much of the tariffs would go through. You know, how much of this was a negotiation ploy, which countries would be affected first. All of these uncertainties have been out there for quite some time, and this just puts perhaps a different slant on some of those uncertainties. But you know, we still have the basic uncertainties about when is this going to happen, how soon is it going to happen, how much of these tariffs are going to be, and I imagine a lot of those uncertainties are going to be in place to some degree or another, you know, for some months. But although, you know, tariffs are seen as a strong dollar policy and an instrumental part of that because of the inflation that they would bring to the US, we've also got to look at euro dollar, the other side of the coin, that the euro in isolation. And I would say that this is, or the story of parity is in part because of the weakness of the euro. And I've been saying, you know, for a long time, through large parts of last year, that the resilience of the euro, certainly through the first half of last year, was, I think, one of the biggest unsung stories of FX in 2024. Now, the euro buckled in the last quarter. It gave away, excuse me, some ground. And that, I think, is because the market recognised that the ECB had turned a hell of a lot dovish, and it took away the protection that the euro had and really opened it to the issues of the structural issues that for instance, Germany has, France's budget issues, and actually the deep ingrained political problems that Italy has, and that's been demonstrated perhaps over the weekend by the collapse of the coalition talks in Austria, which do have parallels with what's going on in Germany and France too.
Jane, what I'm hearing from you is that to get to parity, it's actually more about European weakness than the dollar strength. When do you think we can actually see euro-dollar hit parity?
Well, I mean, to be honest, I think it's a story of both halves. I think we just need to look at the euro story as well as that story of dollar strength, which, is a fairly universal story. But the euro story is very important. Now, our official call is in the second quarter of this year, so anytime between March and June. But look at the way that the euro or euro dollar has performed over the Christmas break, over the last quarter. In fact, if we look over the last quarter, the euro hasn't been the worst performer. Various other G10 currencies have underperformed the euro, but the fact that we are so close to parity perhaps draws our attention to the weakness of the euro and the strength of the dollar versus the euro. Now, I do think that it could happen, certainly by around March. But I think for that to happen, we would have to be sure that inflation is or has become a lot more benign in the Eurozone. And we do, of course, have key CPI data this week for the Eurozone. If that is the case, the market will retain this view that the ECB has turned a lot more dovish. And I think that can really continue to expose the euro to Europe's political and Germany's structural issues.
Which raises this question, Jane. Let's say natural gas prices go up, making the whole disinflation story more complicated for the ECB. Is that good or bad for the euro?
Well, if the market has already priced in an awful lot of easing for the ECB. So from that point of view, you could already argue that there's enough ammunition perhaps for some pullbacks in euro, and certainly we're seeing a little bit of that today. If there was more inflation there, the market would have to take out some of that pricing in of rate cuts from the ECB, and that could strengthen the euro. And that's why we're not actually calling a move below parity, at least not in this moment, because we've heard from Lagarde, they're nearly there in terms of the battle against inflation in Europe, but just not quite. And there are still those resilient uncertainties about inflation that we need to get through first. And only, I think, if that happens, can we start to talk, very seriously about a sustained move below parity.
Jane, how much control does the European continent have over its own destiny at the moment?
Well, at the moment, we're lacking strong leadership in many parts of Europe. So, it's certainly reduced. I mean, clearly, tariffs is a big threat to European trade. And therefore, we have strong leadership in the US in the form of Trump and his tariffs, very weak leadership in Germany, very weak leadership in France. And this weekend, no real leadership in Austria too, and that's a concern. For instance, the far right in Austria is pro-Russia. We've got the Ukraine war, of course, on the doorstep in Europe at a time where Trump is putting extra question marks about NATO, where Europe is on the back foot trying to catch up in terms of spending on defence at times where its budgets are very stressed. So this is a time when Europe really could do with strong leadership, and it doesn't really have it. So it is a risk factor, and I think it's a risk factor for confidence in the Euro project and therefore the euro.
Jane, appreciate your time, as always. Jane Foley there of Rabobank. Out of the City of London, euro dollar 104.20. Talked a lot about this over the last month or so, how little needs to go right to engineer big moves in a currency. And when we talk about how little needs to go right, just a little story out of the Washington Post suggesting that maybe, with a big maybe, some of these tariff efforts get watered down.
Yeah, basically get ready for the next couple of months, because this probably is a preview.
104.20 on euro dollar. Up next in the second hour of Bloomberg Surveillance, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management, Henrietta Treyz of Veda Partners, the former World Bank President David Malpass, and Jim Bianco of Bianco Research.
on the fixed income side, we still see a lot of challenges.
We've come into this year with no bond bulls.
My friends, the bond vigilantes are acting up again.
There's a big divergence right now between disappointing economic data coming in and the 10-year Treasury yield moving higher.
I think we're actually going to see a year where the data plays an even bigger role.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Check out the equity market, looking for 2 days of gains on the S&P 500, higher by 0.75% on the S&P. On the Nasdaq 100, up by a little bit more than that, up by 1 full percentage point. The headline of the bond market earlier on in the session came from the long end of the yield curve. The 30-year yield briefly, the highest since 2023. Yield since then declining just a touch. We're down by a single basis point on a 10-year maturity. The big moves in the last 60 minutes or so, right here in foreign exchange. The dollar is weaker. You are seeing a stronger euro, a stronger Mexican peso, a stronger Chinese currency as well, off the back of this headline from the Washington Post that President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country but only cover critical imports.
The hope being baked into the equity, into the foreign exchange market, is that this means a more tempered and targeted approach from the Trump administration. When you take a step back, the bigger takeaway to me is just how much of a move we saw on this headline about what even is being considered, not even necessarily that's going into proposal before we even get to January 20th.
Well, as Jonathan said earlier, though, the market has pretty much priced in the day after the election, or even actually weeks before the election, a Trump administration. And I think what the market is picking up on the fact that this might not be the universal tariffs and the ring around the wall of the United States that he was promising. And if it is more narrow, then that is great for other countries. But as Leland Miller said, this is the sausage making in real time. And we just don't know yet exactly what their incoming president is going to decide on.
No final decision has been made. I don't know what critical imports are. Critical imports to who? That's kind of important at this point. That might be rather subjective to the incoming administration, so I'll leave that one there. But put it all together, this morning is pretty bullish. You've got them talking about one big bill passing by April for Republicans down in Washington, D.C. At the same time, you've got a report from the Washington Post that maybe the universal tariff effort will be diluted. Is it any wonder that equities are up again this morning by the amount they are?
Bullish for equities. And I think that this is sort of the key tension right now. All of that is very bullish for equities, especially because of the implicit message from this super bill, this very big, beautiful bill that would get passed, is deficit expansion. And this question about how much debt would have to get issued ahead of a week where we have $119 billion of issuance, including 30-year notes on Wednesday. A real question here about how much a check the bond market will be on this sort of everything is fantastic move that we've gotten in equity markets until the end of last year.
Terry Haines says 2025, the bond market has a voice, and they may be the ones that are going to decide the size of the deficit. And Terry Haines, even though Donald Trump is saying in black or white, it's going to be one powerful bill, he's saying potentially it might end up being two reconciliation bills. Again, the sausage is being made in real time. We definitely have some markers in the sand, but right now, we still don't know for sure.
Off the back of those headlines from the Washington Post, bond yields down at the front end just a little bit. 2-year yield down by 3 basis points and a dollar weaker against pretty much everything in G10. Big lineup this hour. Coming up, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management as stocks look to build on Friday's gains. Henrietta Treyz of Veda Partners on President-elect Donald Trump's expensive agenda, and former World Bank President David Malpass on how Congress can fix what he calls the fake debt limit. We begin this hour with stocks rising to start the first full trading week of the new year. Investors piling into tech stocks over the last 12 months. Dan Greenhaus of Solus weighing in, saying Nvidia and AI are still the dominant story, given the size of those companies, and the single biggest risk is the same as it was in 2024. Some disappointment or demand slowdown for this story. Dan joins us now for more. Dan, Happy New Year.
And Happy New Year to you,
sir. Good morning. Good to see you.
Good to be seen.
Is this more important than maybe what's going to happen down in Washington, D.C.?
Nvidia? Yeah, I think so. I mean, listen, this is not to dismiss other risks, particularly on the rates front, the tariff story, another coronavirus pandemic. I mean, there's always things about which we should worry. I just think given how much the broader equity markets are being driven by that AI story, not just in the chip names, Nvidia, Broadcom, et cetera, but in the derivative plays, the industrial names that are building it out, the HVAC names, the rack companies, it permeates so many different parts of the market. I think if there was some material slowdown there, it outweighs the other risks.
Do you just assume that underlying growth with all that going on is going to be okay? Things are going to be okay?
Well, that's obviously separate from the economy. And yes, I think the GDP seems to be doing fine. I think we're talking about somewhere around 2.5% for the fourth quarter, somewhere around 2.5% for the year 2025. Whether it's 2.7 or 2.3, I think is largely irrelevant to the market. But from an economic standpoint, at least right now, what derails that, I'm not quite sure.
So basically, you're watching Huang Jensen, you're feeling pretty good, and you don't really care about bond yields.
No, it's not that I don't care about bond yields, but I think I didn't say that.
Well, I guess I'm wondering. I mean, the big sort of sticking point here is good economy, everything's fine, and then there's this real anxiety creeping into the bond market. Okay, everything's fine because of fiscal expansion ongoing, as well as this idea that maybe inflation's not going to be killed by rates where they are. At what point does that become the fly in the ointment for you?
So the inflation's not going to be killed by rates where they are. Listen, inflation has normalized. Is it at 2%? No. As an economist, am I disappointed in that? Sure, although I'm not an economist. But if I were, would I be disappointed in that? Yes. But as an investor, which I am, whether it's 2 or 3% is largely irrelevant to me. Obviously, that matters in the context of policymaking and how that impacts the market. But from a broad market standpoint, 3% inflation is not particularly deleterious. And as we've seen over the last 2 years, the equity market, largely speaking, doesn't care. With respect to yields, listen, break-evens are basically unchanged. I don't think there's any, at least from an evidentiary standpoint, I don't think there is any explosion of inflation concerns. I think certainly the risk is that we don't get back, the consensus now agrees that we don't get back to 2% relatively quickly. But I would add, and the point I was building up towards, is the Fed told me that 2 years ago. They said 2 years ago that inflation was not going to get back to 2% until 2026. Now it's 2027. And they were not willing to do the work on rates to get it back there sooner. And so as an investor, I'm left with inflation normalizing, not as quickly as thought, and a Fed that's not stepping on the brake as quickly as they think they need to. And that's positive for risk assets. And I think that stays in place for now.
That's positive for risk assets. When you overlay that, though, with policy prescription from Washington, D.C., that by all accounts will probably increase the deficit by anywhere from $1 to $5 trillion and even upwards of that. At what point do you start to worry about real yields, about when you strip out inflation expectations, this idea that bond vigilantes are back having a voice at the table and they're not happy?
I don't think you meant to do this, but I take issue with it. The extension of the tax cuts will not increase the deficit. It's going to increase the debt over the 10-year period. It's going to cost $5 trillion in the out year. But I think most assumptions take into account that the tax cuts are going to be extended here in the short term. That said, 7% deficit to GDP ratio is just astronomically high, unacceptably high, and to use a scientific word, gross. But that's getting done. The tax cuts are getting done. It's not like the bond market's going to be surprised when we pass that reconciliation bill, either the first or second later this year. And we know the Penn Wharton, we know all the private estimates are somewhere in the $3 to $5 trillion range. I don't think that's a surprise to market, I guess, is the point that I'm making. With respect to yields, yeah, like we've clearly seen risk assets struggle when the 10-year gets up into the 4.75 to 5% range. We're obviously not quite there, although equities are already wobbling. If we were to move higher, again, I think that's probably going to elicit some type of response. But the push-pull in markets is going to be, you're going to see thereafter, perhaps, probably, yields start to come back down from that level for whatever reason. There are numerous ones we can discuss. And that'll eventually, as long as the economy is doing fine and earnings are doing fine, which I think is your baseline, a resumption of that upward move.
How are you thinking about tariffs when last night President-elect Trump said that one powerful bill is going to be paid for mostly by tariffs? And this morning, the Washington Post says, well, it's going to be narrow, targeted tariffs on critical imports.
John, I think, put it perfectly at the start. We're watching the sausage get made. And I don't think any of us know, I'm not even sure the administration knows, what the final set of tariffs are going to look like on who. John made the most important point. What's a critical material? One person's critical material is another person's industrial input. So I don't know how to model or how to think about this because I don't know on whom, by how much, for how long. And alternatively, I don't know who is already circumventing the supply chain. We put tariffs on China. What good does that do me if I ship my goods to Vietnam and then ship it out of there? And we've seen this where our imported goods from China is lower today than it was 5 years ago. But look at our imports from Vietnam, Malaysia, Indonesia, et cetera, they're all higher. So this is a series of whack-a-moles here. That said, one big beautiful bill, he can say that. I think, as you know, Congress probably is going to disagree with that.
But when you put all of this together, what is your base case for what actually does get done in 2025?
On tariffs?
On tariffs, on the corporate tax rate, on immigration policy?
I don't see any. Okay. My personal opinion, I don't see any way the corporate tax rate is lowered any further. I would be shocked if it's lowered by any amount, 1 percentage point. I don't think there's stomach there for on the Hill, and you know better than me, but I don't think there's stomach on the Hill for the no tax on tips, et cetera, et cetera. I just don't think there's room in the budget for them to do that, and I don't think they will. Obviously, the TCJA is going to be extended. Those tax cuts will be extended, but I don't think any new tax cuts will be applied. On the immigration front, I'm less concerned about this from a market standpoint than some other people. Housing, obviously, and industries, leisure, hospitality, et cetera, that disproportionately rely on imported, undocumented, or illegal immigration are going to be hurt. But I don't know that it's the broad inflation disaster that some people are making it out to be. So that's my working view of things. I think, listen, from an investor standpoint, we're looking at companies that are doing quite well, that have clean balance sheets, that have good thematic stories, et cetera, et cetera. The stuff that we're talking about is all super important for the broader market and the risk landscape in general. But from an individual company standpoint, most companies are immune. Most companies are immune. Not all, but most companies are immune.
When you find those companies that you like, you're more comfortable taking equity risk or credit risk? Where do you find the bigger opportunity set right now? In fixed income or in equity markets?
Probably in equity. And you've asked me that question intermittently over the last year, and I've said credit at points. I think right now, the problem with the credit market is not the problem is not the right word, but the issue that you have in the credit market right now is the lower rated credits where you might get a much more attractive yield, 13, 14%, have experienced a tremendous rally over the last couple of months. And so the yield on the CCC index now, and I've said this 100 times, it bears repeating, CCCs are just a group of companies. They're not really an index, but CCCs are yielding somewhere around 10% right now, 400 basis points lower than a couple of months ago. And so a lot of that attractiveness has come out of the market, and as you saw in the equity market with the big rally. So I think if you're going to get paid, you're taking effectively equity-like risk in some of those lower rated credits, in which case you might as well get the potential of equity-like returns by taking that equity risk in the equity market. And so on balance, I think we're seeing probably more opportunities in the equity market right now, but that's not to say there's nothing to do in credit. I just think on balance, you're probably getting paid more in the equity market.
Equities up this morning by 0.7%. Dan, it's good to see you.
Always my pleasure, guys.
Thank you, sir. Dan Greenhaus there of Solus Alternative Asset Management. I want to bring you this headline, widely expected. It comes from Nippon Steel and US Steel filing lawsuits on their deal and calling it deal interference.
And what they're talking about is the interference from the President of the United States, Joe Biden, and the debate that really took place in the West Wing on whether or not to talk about domestic political concerns versus is this real a national security concern, given the fact that Japan is an ally. So we have that now as a lawsuit, and then tomorrow we should also be hearing from Nippon Steel.
We talked about this last week, closing a chapter on all of this. We're not closing the chapter on anything, can we?
No, and it sounds like the Japanese government is going to back Nippon Steel with respect to their lawsuit against the U.S. and saying that essentially this really undermines the alliance between the two. So get ready for a lot more of the same.
It's not going away. Let's get you the latest elsewhere with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. A new report last hour from the Washington Post suggests that President-elect Donald Trump is exploring a universal tariff, but one that would only cover critical imports. 3 people familiar with the matter told the Post that Trump's aides are still discussing the plans to impose the duties on every country. It would, though, be a paring back of the most sweeping plans from Trump's 2024 presidential campaign, where he called for tariffs as high as 10 or 20% on everything imported to the U.S. United Airlines expects to begin using SpaceX's Starlink for in-flight Wi-Fi in the spring. That's an earlier than expected rollout. United said in a statement on Sunday that only members of the carrier's loyalty program will get the service for free. It marks a departure from the original plan, which would offer all passengers the service free of charge. And the U.S. are United Cup champions once again after Coco Gauff and Taylor Fritz took down their opponents from Poland in the tennis tournament. Gauff took down world number 2 Iga Swiatek in straight sets despite winning just 3 of her previous 13 matchups against her, with number 4 ranked Fritz beating his opponent in a tiebreaker in the men's singles. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Donald Trump's expensive agenda.
I am still shocked that I don't think that the market fully has embraced how much deficit spending I think we're about to do.
That conversation up next, live from New York City this morning. Good morning. Equity futures right now on the S&P 500 up by 0.7%. We've got some big moves to talk about in foreign exchange. Euro dollar back at 104. 104.16, up by 1 full percentage point. I get it. Not much needs to go right in Europe to engineer a big rally, given the sell-off that we've seen. But this came from the Washington Post a little bit earlier this morning that President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country but only cover critical imports. Now, I've got more questions than answers right now, but certainly the move speaks for itself, Lisa. It's a sell-off in the US dollar.
And you say this has to do with not much has to go right for the Eurozone, but you also see a similar size move in the Mexican peso. So to your point, this is broad-based and showing the volatility and sort of the expectations baked in about tariffs and what we'd have to see to ignite a whole lot of volatility in some of these basic currency pairs.
Just waiting for that headline, that post from the incoming president, when he finally gets to read this later on this morning, and an aide just sort of pushes the story over and says, what do you think?
Yeah, he'll say critical infrastructure is absolutely everything under the sun because basically everything that you import is critical to us. So, good morning.
Or when we get the hearings from Jameson Greer and Howard Lutnick when they start talking again about broad-based tariffs, this is as Leland put it, sausage being made. You're going to see the debate, as we saw during Trump 1.0, played out very much so in public.
Looking forward to another 4 years of this. This is the latest this morning before we even get started. Inauguration, January 20th. Under surveillance this morning, Donald Trump's expensive agenda.
I am still shocked that I don't think that the market fully has embraced how much deficit spending I think we're about to do. I think that we're going to have $6 to $7 trillion in deficit finance spending come out of this Congress.
So here's the latest this morning. President-elect Donald Trump sharing that the Republican-controlled Congress is working on one powerful bill that will bring our country back, adding the bill will focus on the border, energy and tax cuts. Henrietta Treyz of Veda Partners warming to prepare for a giant deficit number, writing, we expect federal spending to rise at least on pace with inflation. The main takeaway is that total deficit increases incurred by legislation passed in 25 could easily exceed $5 trillion. Henrietta joins us now for more. Now, Henrietta, as you know, 5 sounds like a big number, but for many, that's just a baseline. You extend TCJA and you're talking about 4 to 5 trillion. So upwards of what? How big could that number be?
Yeah, I mean, to get to your point from the earlier conversation, this is absolutely deficit increasing spending. The reason the tax cuts expired at all is because in 2017, $1.5 trillion was the deficit authorization. That was used and thoroughly exhausted, and now we have to do it again. So this is 100% adding to the deficit beyond what is the existing baseline. So extending the TCJA is $4.6 trillion. That does not take into account the fact that they do not have the votes to maintain the SALT cap at $10,000. That's your single largest revenue raiser at $1.2 trillion. And if you have to raise that to $20K, which would eliminate the marriage penalty as they describe it, or even further beyond that to get those 18 SALT caucus members, you're going to make the bill even more costly. Then I think you're also going to run into issues with repealing the Inflation Reduction Act. Those energy tax credits disproportionately go to red states and job creation in red states, and Republicans are going to have a hard time voting for those as well. So there's really no pay-fors. The tariffs, of course, will not be voted on by Congress, and so they will not be included in the score that we get for the tax bill. This is going to be a massively deficit increasing number that we see just from this one reconciliation bill, before we even take into account the military spending of at least $200 billion and more besides.
Henrietta, we haven't even got to the point that President-elect Trump also gave a shout out to extending the tax cuts and talking about one campaign promise that even Democrats welcomed, which is no tax on tips. Do you actually think that gets done?
No, definitely not, because of the problems that it incurs for Social Security and Medicare, spending from which the payroll tax and other taxes goes towards funding. So
but hold on, why is he then putting it in black and white if there's no appetite on Capitol Hill?
Because I think he's not in Congress yet. He's saying a lot of things that are going to be really difficult to get through, such as reducing the corporate rate to 15%, which is a non-starter as well. When I talk to Republican staff, they say, we don't really have any interest in reducing the corporate tax rate. And that's very much what you hear behind the scenes on no taxes on tips. It just doesn't have support on Capitol Hill. It's really a giveaway to Nevada is the way a lot of members think about it. And of course, those are only 2 senators.
So, Henrietta, who is the voice that we should be paying attention to? Is it the Trump tweets? Is it Speaker Johnson? Or is it incoming Senate Majority Leader John Thune?
I think that you should definitely focus on the House and Senate members, as the president does not have the authority to write tax legislation. So it's Jason Smith and the House Ways and Means Committee, Mike Crapo at Senate Finance. Those are the 2 senators, 2 members who are going to be working on writing the details of this bill. But more importantly, think about the members who are up in 2026. That is, of course, every single House member, but then some really key senators like Tom Tillis in North Carolina, Susan Collins in Maine. Those are going to be your linchpin deciders, especially when it comes to any spending cuts that they might want to see. Those members are going to be the ones who say, hold the phone, we're not ready to take those cuts yet.
How powerful, Henrietta, are the members going to be sitting behind their Bloomberg terminals trading 10-year notes?
I think that is definitely the least powerful member in the room. Not a lot of senators or congressmen are necessarily focused on what the market does. I know there's a perception that Trump cares very deeply about what the market does on a day-to-day basis, but look at what really happens. Lawmakers are going to write the legislation that they see fit, and the deficit spending continues to rise every single year. We're talking now about roughly $5 trillion in spending just in 2025 alone on a combination of this tax bill, keeping the government open, hiking the debt ceiling by another $1.5 trillion, et cetera. It's not going to factor in. They will be increasing the deficit.
Henrietta, there's a larger question here, though. If that member doesn't necessarily have the same clout, how much the deficit increases just by virtue of how much yields have risen? Yields have risen some 70 basis points last year. On the 10-year, they're continuing to rise into 2025. At what point does that become a limiting feature in terms of what they can do just simply because that rate alone expands the deficit?
I just don't see it really having an impact in D.C. It's definitely a conversation in boardrooms in New York and on Wall Street. But when you go to D.C., they talk about the near and present danger of the expiring tax cuts, about the potential for default, about the need to keep the government open. There's not a break on federal spending when there's a to-do list. And this is the 1 year that Republicans have majority control over all 3 chambers, and they have a massive to-do list. They have to get it all done this year. And what will happen is what usually happens. As we get closer to a midterm election cycle, everybody starts to clutch their pearls again. So we'll have a conversation around reducing federal spending, reining in the debt, talking about interest in 2026. The DOGE, or the Department of Government Efficiency provisions, are expected on July 4th, 2026. That's 4 months before the midterm elections. There's no scenario where we cut the deficit by trillions of dollars 4 months before a midterm. It's just not realistic to anticipate politically. So you'll hear the conversation start in 2026, but in the immediate term, 2025 is all about spending.
Henrietta, appreciate your time, as always. Henrietta Treyz there of Veda Partners on the latest. Are we 50 basis points away from a different conversation? 100 basis points away from a different conversation? How much higher do bond yields need to be?
Honestly, she was saying that's not really the focus in Washington, D.C. At a certain point, though, it has to become, because it adds to the deficit and reduces how much they can spend. And frankly, it comes under this question of the debt ceiling and a whole host of other issues. But it's a good question. At what point do the debt vigilantes get the main seat at the table?
David Malpass, the former World Bank president, joining us shortly with this to say recently in a Wall Street Journal op-ed, saying the outgoing government is leaving a tailor-made debt crisis for Mr. Trump. That conversation just around the corner. If you are just joining us, equities near session highs of 0.75% on the S&P 500. Bond yields a little bit lower. The dollar weaker, euro stronger, euro dollar 104. That currency pair positive by 0.9%. Equities close to session highs, up by 0.7% on the S&P 500. On the Nasdaq 100, up by 1 full percentage point, with 2 hours away from the opening bell. With your morning movers, here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. It was the Mag 7 that had a revivalist movement on Friday, up 2.5%. Kick it off with Boeing this morning. Barclays has decided to go overweight. So this is the first time they've turned bullish on this stock since 2019. They've upgraded the stock price to $210, so a considerable uplift from here. The original target price was $190. Why? Why turn positive for the first time since 2019? They shored up the balance sheet, and it is no longer an overhang. Sustained positive momentum for production and deliveries, and this is critical to the story of Boeing. What are they going to reset the max production to? Where do we get to in 2025? Stock is bid this morning. NVIDIA, I talked about the Mag 7, we're up 2.67% this morning. Add on your 4.5% bump that you had on Friday. That gives you nearly 7% in the space of 2 days. Honhai, our Foxconn, has seen a 15% jump in their revenue. So that's emboldened the story. Microsoft coming out and saying, we're going to spend $80 billion in the fiscal year coming. Last year in the fiscal year, they spent $50 billion, so that mega capex story remains, and it is emboldened again at Microsoft. $80 billion for the fiscal year. I'll leave you with a snapshot of GM. The deliveries in China jumped by 40% quarter on quarter, 600,000 units there. In China, in the complete year 2024, they sold 1.8 million vehicles. 50% of those sales in China were in the EV space, and half of their annual sales were in that. Just a fact for the day. Here in the United States of America, Toyota sold nearly 1 million EVs, hybrids and EVs last year. This company sold 114,000, and they don't have a hybrid. Go figure.
Manus Cranny, thank you, sir. Stock up nicely in the pre-market by 2.5%. Lots of news to get through. Under surveillance this morning, Secretary of State Antony Blinken hoping to broker a ceasefire deal in Gaza before the end of the Biden administration. Blinken telling reporters, quote, "We very much want to bring this over the finish line in the next 2 weeks." Elsewhere, New York City drivers now paying up to $9 to enter the busiest part of Manhattan. Today marking the first regular weekday under the country's first congestion pricing program. President-elect Donald Trump and Governor Phil Murphy of New Jersey still vowing to fight the toll. Our very own co-host from Queens with some strong feelings on the matter.
Well, Trump has called it a regressive tax. What I have heard officials talk about really for years that are on the outer boroughs, and as they say that their constituents that have to go into Manhattan that have no choice but to take their car, this is going to hurt them the most. The MTA is desperate. It needs money. But many say, is this really the best way to fund it, especially when more people have a lot of anxiety these days about getting on the subway due to safety concerns?
There's a little bit of what comes first, the chicken or the egg, right? You can say it spends too much money, it's badly managed in terms of the MTA and the subway system, but if they need more money to make it safer, to make it a better option, to make it faster for people to be able to go in, then how are they going to do that at a time when the federal government is going to do that? So ultimately, that is the question, how you do that, how you sort of thread this needle. Good luck.
Can I address a myth that is going around Europe? There is a story that they believe.
Yes.
The story that Europeans believe is that Americans don't really pay taxes. And they come to places like New York and they see the infrastructure and they're like, they need to start paying taxes to invest in the infrastructure, to make things safer, make things run better. We pay taxes, lots and lots of taxes. Believe me, it's how they spend the money and how much money is being wasted that I think speaks to what's happening right now with the incoming administration and Elon Musk. Do we really need to give them more money? Or do they need to spend the money they're getting more efficiently?
Again, and I would agree with that. Can you do both at a time where they need signal repairs? I mean, this weekend you saw all the subways shut down on certain lines because they had to repair signals that last were put in place in 1967. So here's the question. At what point do you incentivize the political will to be more efficient by actually charging money to people that suddenly care about where that money is going? I mean, this is a larger question about how politics is run, and I am not the person to have it. But I will say it is an important one to be had.
But John, to your point, if you're a New Yorker, you're paying federal tax, you're paying state tax, and you're paying an extra city tax. I also lived in London, where I paid a ton of tax, similar to actually what you end up paying when you put it all together in New York, yet you saw your money put to work. Never felt unsafe taking the underground. Never felt unsafe really walking around the city. Never saw garbage on the streets. Very different in terms of how they use the money and where the tax this money's being spent.
This debate's not going away, and we can have it another day. I need to turn to this, the weather. It's freezing outside. A major winter storm making its way across the United States. Millions of people bracing for a mix of snow, freezing rain and sleet as the day begins, with more than 60 million people under winter alerts nationwide. Alex DaSilva of AccuWeather joins us now with the latest. Alex, is it as bad as people feared?
Yeah, it certainly is, and it's a very widespread storm we're dealing with right now, stretching anywhere from the center of the country all the way to the East Coast. We've seen reports 6 to 12, even 18 inches of snow back across Kansas and Missouri, with up to 3/4 of an inch of freezing rain. Down trees, power lines across Missouri, Kansas, and into Kentucky as well. But where's the snow now? It's heading towards the big cities. Right now, Baltimore, Washington, D.C., right around 4, 5, 6 inches of snow right now, and a couple more inches will be on the way throughout the day today, as well as some freezing rain down here. What we got to watch out, Richmond, Roanoke, they could pick up maybe 1/10 to 1/4 of an inch of freezing rain in some of these areas as well.
Alex, I've got a New York bias. When do I need to call in sick? Thursday? Friday?
Yeah, well, New York City, we're keeping a close eye out for. I think the snow probably gets there sometime this afternoon, late morning into the afternoon. Doesn't look like a whole lot, maybe a coating to 1/2 an inch, maybe up to an inch, but I think most of the heavier snow will be off to their south.
Got it. Alex, thank you. Appreciate the update. We'll get an update from Alex tomorrow as well, I hope. Alex DaSilva of AccuWeather.
So 1 inch, you could call it out with the flu?
Yeah, you know, that's a very British thing to do. 1 inch of snow, it's just like...
It's also what they do in Washington, D.C.
Maybe they don't know how to handle it there, but I would hope that we could do better than that.
In Washington, D.C., this is actually a huge problem. They don't have the infrastructure set up to clean the streets. Everyone freaks out when it snows, although someone did send me a message today saying the news is not actually matching what I'm visually seeing outside my window this morning.
We slated the subway system in New York City a little bit earlier. Can I just say, when it snows in Manhattan, it's pretty impressive how quickly things go around and... clean up pretty fast.
Wait, hold on a second. This is impressive. Saying something
just,
nice about the subway.
Not the subway. I just mean
street clearing.
Street clearing.
Okay, well, you know, both. It's the fastest way to get around when it snows, just say.
Let's turn to politics. President-elect Donald Trump calling for the debt limit to be abolished before he returns to the White House on January 20th. The former World Bank president David Malpass, writing in a Wall Street Journal op-ed, President-elect Trump was right last week when he raised a red flag over the debt limit. The outgoing government is leaving a tailor-made debt crisis for Mr. Trump that complicates his work to implement his mandate, cut taxes quickly and rebuild US strength. David joins us now for more. David, welcome to the show, sir. It's always good to catch up with you. I just want to address that one line in the op-ed, a tailor-made debt crisis. Can you just explain that a little bit more?
That's right. This has been coming on for a year, for 2 years. They kind of planned it so that the new president, the next president, would have the problem. So Congress spent all the money. And so it's tailor-made for a crisis, because if you don't raise the debt ceiling, you have a default on the national debt. What I've wanted them to consider is rewriting the debt limit so that it actually works. You've got to stop the spending before it happens rather than after you've already spent it.
David, we heard over the weekend from Mike Johnson, House Speaker, that there's going to be one big, beautiful bill, and it's going to probably come in April, and it will be put through by reconciliation to get all of Donald Trump's agendas in place. We were speaking with Henrietta Treyz. She said this could expand the deficit by some $5 trillion. Do you think there is the will to start to revise the debt ceiling debate and some of these other issues to structurally reduce the deficit under the Trump administration?
I think there's a strong will to reduce spending. One of the things going on is Biden is leaving the cupboard bare as he leaves office. That means they've spent up as much as they can on the current fiscal year. They're in the process of obligating. Every day that goes by, they're obligating huge amounts of money that can't be gotten back through the rescission process. So if you make a grant and you obligate the funds, you can't get them back. And then another way that the cupboard is bare, and it's showing up in the bond market, is they've kept the issuance of debt short term. So one of the biggest decisions facing the new administration will be what maturity to issue at, and does the Federal Reserve buy back all the long-term debt? You know, the Fed is this giant hedge fund. It's owning all of the long maturity, or a big chunk of the long maturity bonds. So I think over the last 3 months, they've lost maybe $650 billion just on having a bad bond trade. Yields have gone up. So they're the big holder of long-term yields. So the consumer feels okay, but the government itself is losing massive amounts of money until they find a way to slow down the spending machine.
Do you think, just to sort of build on that, David, that the reason why we've seen that rise in longer-term yields is because of the deficit? Is this truly the bond vigilantes coming back to the table?
There's some of that. The market looks ahead and says, do you have a mechanism to actually control yourself? And so the bond yields are having multiple problems. One is the Fed's models are really broken. So the Fed is basically saying, if you have more growth in the economy, we assume it will be inflationary, and so we will have higher interest rates. So it's a broken models problem. But then second, as I mentioned, the duration of the government was held down. The Fed was buying, the Treasury issued some long-term treasuries, but then the Fed bought them back. And so this is a major problem because you have to get over the hump. You can do that through confidence, and that means, are you able to repeatably, over and over again, cut spending? Do you have a mechanism to actually control what Washington spends? That's yet to be seen, but I think they can do it.
David, I don't really see any restraint right now with the incoming Trump administration. President Trump talked about yesterday one powerful bill, border security, energy policies, renewing Trump-era tax cuts, except making them better to include no tax on tips. And we're talking about a president who spent $8 trillion or added $8 trillion to the deficit during Trump 1.0. So where do you see the appetite of Trump to want to cut spending?
It's going to be a combination of increasing growth and production within the economy and making the existing spending more efficient. So if you get more from it and you have fewer people but fewer obligated funds, that's going to be the trick. I want to really put emphasis on this idea of markets being forward-looking and looking at the output of the economy. If you can change the energy system, that means both the production but also the transmission of energy. That's going to have a big downward effect on inflation. The Fed doesn't have that in its models. Each of the Fed's models are broken. One is on how you set interest rates. One is how you use the balance sheet. They've used it very harmfully in terms of the lost money. And then third is their regulatory policy. The Fed has this massive control over lending to small businesses, and that hasn't been going well, but that can be repaired and fixed. You get more output, less inflation, and you can bring interest rates and bond yields down.
Something you've talked about a few times, David. We'll have this conversation again in the near future, I'm sure. David Malpass there, the former World Bank president. In the bond market, bond yields a little bit lower at the front end of the curve. We're down 3 basis points on a 2-year, 4.25. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Joe Biden said that he's determined to peacefully hand over power later this month. Writing in a Washington Post op-ed published last night, Biden said he's, quote, determined to do everything I can to respect the peaceful transfer of power and restore the traditions we have long respected in America. Adding, I have invited the incoming president to the White House on the morning of January 20th, and I will be present for his inauguration in the afternoon. Meanwhile, shares of U.S. Steel are higher in the pre-market, nearly 5%. According to a statement from Nippon Steel and U.S. Steel, the two jointly filed lawsuits to remedy the interference with Nippon acquisition of the U.S. company. The companies say that they are confident that they have, quote, strong cases and will rightfully close the transaction. The New England Patriots have fired head coach Jared Mayo on Sunday after they went 4-13 in his first season as an NFL head coach. The move came soon after their season-ending victory over the visiting Buffalo Bills, which ended up costing them the top pick in this year's draft. The 38-year-old Mayo played linebacker for the Pats from 2008 to 2015. His one-year stint as head coach ties for the shortest in franchise history. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, the Fed's data dependence.
I think we're actually going to see a year where the data plays an even bigger role. And we already know that can create a lot of unnecessary volatility because it's hard to measure $30 trillion economy in real time with a lot of accuracy.
That conversation up next. We'll catch up with Jim Bianco of Bianco Research, live from New York. You're watching Bloomberg TV. Another leg higher for stocks. On the equity benchmark, the S&P 500 up now by 0.8%. We're down by about 2 basis points on a 10-year, 457.74. Under surveillance this morning, the Fed's data dependence.
I think we're actually going to see a year where the data plays an even bigger role. And we already know that that can create a lot of unnecessary volatility because it's hard to measure a $30 trillion economy in real time with a lot of accuracy. Part of the Fed's job is to help turn the lights on and at least chart a path. I don't think things are as calm in the labor market as the Fed kind of in their latest projection seems to view it.
Well, here's the latest this morning. Both San Francisco Fed President Mary Daly and Governor Adriana Kugler speaking over the weekend, saying the central bank must reach its 2% inflation target. We've got a full slate of Fed speak on tap this week. We'll hear from Barkin, Waller, Harker, Schmidt and Bowman and get minutes from the Fed's December meeting. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the programme and Happy New Year, sir. As you think about the risks for 2025, how do you see things? Is the bigger risk an employment stumble or the bigger risk a re-acceleration in inflation?
Oh, I think the bigger risk is reacceleration, not only of inflation, but of the economy, too. We've been seeing the economy. Economists like a term called potential growth, which is not measurable, but what do they think the economy would grow if we're not stimulating it or slowing it down? And that's about 2.5%. 8 of the last 10 quarters, the economy has grown at least at that level, and it's looking like it might do it again in the fourth quarter once we get those numbers at the end of the month. Add into that the inflation rate is not getting to 2%. There is an argument to be made that it is stalling it around, the high twos if you measure it by CPI, because we're at the same levels on year-over-year CPI that we were 7 months ago. And all of this is just suggesting that the acceleration story is going to be the bigger issue. Now, yeah, there's always concern that the labor market could have problems. But right now, most of the data, whether you're looking at claims or unemployment or payrolls, is not really reflecting that concern, at least not yet.
How much, Jim, does this matter to Jensen Huang? Can Jensen Huang keep on delivering a stock market that gains a little bit even on the margins, even with rates going higher, even with this concern that maybe the Fed was mistaken by cutting rates?
Well, first of all, everybody should care about Jensen Huang because he is the most important person in 2025 to everybody's returns, no matter what market you are investing in right now, because NVIDIA is the driver of everything. As far as he's concerned, it should matter at the margin because it will cost his customers with the ability to buy his products, not necessarily his ability to deliver those products. And that's what we have to be careful of. The AI expansion is going to be unbelievably expensive. The energy needs are going to be very expensive. The power companies that are going to have to power it are going to need to borrow a lot of money. And so it's going to matter whether or not the economy does accelerate and they have to pay higher interest costs in order to finance this AI boom.
I guess the larger question here, Jim, is tech outperformance the only thing that can rescue a market with yields where they are, given how much they climbed last year and how much they continue to climb early this?
Yeah, except if you look at the stock market, what's interesting is that the S&P Friday's close was within 1 point of the close the day after the election. So the S&P hasn't really done a whole lot, since election, other than the initial surge on the day after the election. It's at the same level that it was back then. And why is that? Because I think interest rates are getting in the way and that we are at levels that are problematic for the stock market. And if we continue to see any kind of growth or any kind of reason to keep these rates up, it's going to continue to get in the way of the story of, higher stock prices in 2025.
Jim, Speaker Johnson is basically saying we could get this deal done in Washington, one big, beautiful bill, by May. Would the Fed then wait on the sidelines, potentially see what those policies look like in May?
I hope they don't. Chairman Powell has talked about this concept of fiscal dominance. And, to put it in very simple terms, It's their problem. It's not mine. My problem is employment. My problem is inflation, being Chairman Powell, and I will set policy based on those. If there's a deficit or if there's going to be a bigger deficit or a smaller deficit, we just had an election. It's their problem to deal with. It's not the Fed's problem to try and accommodate, higher levels of spending or larger deficits.
But if that is the picture that potentially emerges, does that mean that risk appetite can get worse?
It can. I mean, the thing you have to keep in mind is if you go back to 2019, we used to use the phrase, Tina, there is an alternative. There is an alternative now. There's 5% and 6% yields in the bond market right now. There's a 4.5% effectively risk-free money market rate. So you've got alternatives to the market. Now, I know nobody thinks that those are alternatives because we're all stuck on momentum and that the stock market's at 220% years. So therefore, it must mean we're going to have another 20% year in 25 and probably another one in 26. But actually, the alternatives do exist, and that is going to become, a big hurdle for the market to get over.
Jim, heard a lot of numbers forecast on a 10-year yield. I mentioned Jordan Rochester and the team over at Mizuho looking for 5. 5 is more likely than 4 on 10s in the US. Academy's Peter Cheer also said he's looking for 4.75. Nothing about this administration, despite Doge, points to it being fiscally conservative. What kind of numbers, Jim, are you thinking about?
Well, I think that we're going to probably see him take out the October 23 high. That was when we hit 5.02 on the 10-year note. So I'm thinking 5.5. In other words, a higher high than we saw last in 2023 now, 15 months ago. And that will continue the trend that we've seen since 2020, that we're in a secular rise in interest rates. It didn't end 15 months ago. So, I still think we'll probably take out that 5%. And at this point, that's 40 basis points away, maybe 50 basis points away. That's not that far away when you think about the scope of, you got an entire year to potentially reach that target.
Close to 4.60 this morning. Jim, appreciate your time. Jim Bianco there of Bianco Research, looking for yields to breach 5%, Bramo, in the next several months through this year.
The level that a lot of people here have said is the danger zone, including Lori Calvasina, in terms of equity returns. You just wonder whether there'll be a response, whether there'll be, as Dan Greenhaus was talking about, the buying mechanism that comes in at 5, or whether people start to get a little bit more concerned.
And is it 5% of the 10-year yield that matters more than Doge? Terry Haines this morning, bond market may decide the size of the deficit. How much is that going to regulate the same way, Jonathan, you talked about stocks regulating Trump in 1.0?
Lisa mentioned Dan Greenhaus, though. Dan Greenhaus was very quick to say that the biggest risk this year came from NVIDIA. And what you heard there from Jim Bianco, the most important man for the year ahead, not the President of the United States, not Chairman Powell, but Jensen Huang.
Yeah, the rock star who comes in with his leather black jacket. Is that what we hear from Dan? Every time he comes on.
7% of the S&P, and it's like 50% of investor sentiment. We've said that a few times.
Well, especially because this has been the story that has kept and powered this equity rally. It has been the AI transformation. Can it continue to? And does that end up being the haven trade at a time where yields might continue to climb or stay where they are?
I don't want to be all doom and gloom about NVIDIA, but these companies that are tethered to their chips being made in Taiwan, have they really realized what is going on in terms of espionage of China in the United States? And just this morning, Taiwan talking about a Chinese ship breaking a subsea cable. Is anyone in Wall Street going to wake up to the fact that there is actually geopolitical concerns brewing out in the open when it comes to Taiwan and China?
A story from the Journal over the weekend. Pretty concerning, right?
Oh, it actually kept me up at night.
Yeah.
It actually kept me up. I want to know what people are doing about it.
Pretty shocking. Coming up in the third hour of Bloomberg Surveillance, we'll catch up with Liz Young-Thomas of SoFi, the former New York Fed President Bill Dudley, and Michael Gapen of Morgan Stanley, alongside Greg Peters of PGIM Fixed Income from New York. This is Bloomberg.
We just experienced one of the best 2-year stretches for markets in history.
All the positive news is priced in.
It's hard for me to be negative U.S. equities.
The U.S. growth situation is in pretty good shape.
I'm looking for a bumpy year, and a lot of those bumps are going to be occurring over the next few months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The first full trading week of 2025 looks absolutely stacked, and we're hitting the ground running. Buying stocks up 0.75% on the S&P 500, on the Nasdaq up by more than 1 full percentage point. This week, jam-packed. full of economic data and debt sales, and it includes payrolls Friday. The estimate for Friday, 160K. The previous number, of course, 227. Before we get to that, we need to talk about $119 billion of debt sales across a 3-year, 10-year and 30-year maturity. It's a busy week ahead.
Starting at 1 p.m. today with $58 billion of 3-year notes and finishing on Wednesday ahead of the Thursday day off for equity traders. Bonds are still going to be traded for part of the day on Thursday. But the idea here is how much demand is there at a time when we've seen bond yields creep up dramatically? And this has come from the real yield sector, not necessarily inflation expectations. Is this deficit concerns, or is this just something that's normal? That basically we're getting back to a renormalized yield curve.
It's shaping up potentially to be a really important 24 hours on the debt front. To your point, the amount of supply that we'll get through this week and maybe beyond. We've got Speaker Johnson talking about one big bill being passed by April, perhaps even by May. Now we need to talk about tariffs as well, a more complete picture on the effort from the incoming administration. And we go back to what we talked about through most of this morning. From the Washington Post, President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country, so a universal tariff, but only cover critical imports. This according to 3 people familiar with the matter.
So when you think about critical imports, you think about things that are detrimental to national security and economic security concerns. We need more details, but as Leland Miller has said, this is the sausage being made in real time. My question then would be to the president-elect, what's the pay first? Because he put out a tweet last night saying there will be this one powerful bill, border, energy, reviving the Trump-era tax cuts, including expanding them, like no tax on tips. And all will be made up with tariffs. Well, how is that going to happen if they're not blanket tariffs and they're actually only targeted and narrow?
Get ready for your head to spin with all the potential proposals and the whipsawing from all of the headlines. And this really goes to the crucial point that you brought up earlier today. Stuart Kaiser made it last week. Is this 2017, which was low volatility, big promises, big expectations baked into risk assets? Or is it 2018, which was high volatility with all of the potential implications coming in and sort of seesawing, leading to actually a negative return on the S&P 500? That's really going to be the key. And one of the big takeaways from some of the big moves that we've seen in the FX market on some of these headlines.
There is, of course, potential to be whipsawed by all of this. We've mentioned this a few times already this morning. The incoming president only needs to post on Truth Social or on X and just turn this market in the other direction. But I think this morning's an important stress test. We always say this. You can learn something from the data, the information, or the way the market responds to it. I think what you've learned this morning is that headlines around trade and tariffs are more important to the likes of the Europeans, to the Canadians, to the Mexicans, to the Chinese than they are maybe to domestic American markets.
Which has been one of the big takeaways that a lot of people have said. Basically, the U.S. catches a cold, everyone else catches the flu, especially when it comes to tariffs that people thought just simply put a moat around the U.S. and reinforced its exceptionalism.
And when it comes to tariffs, they could be immediate. Donald Trump on January 21st, or I guess on January 20th, after he's inaugurated, could go to the White House and talk about tariffs and have executive orders on tariffs. When it comes to the big, beautiful bill, that is going to take months of debate and negotiation. And one viewer actually texted me when the Washington Post article came out and said the main issue is that Trump wants tariffs, but he also wants stocks to go up. At some level, you can't have both.
Stocks went up on Friday. They're up again this morning. And I would say some of that came from how smoothly things went down in Washington on Friday morning. We were looking for a mess. We didn't really get one. Speaker Johnson sailing through pretty smoothly.
Yeah, basically, he had one vote. A couple of holdouts said, actually, let's just pause, take a break, came back, got passed through. Just remember what happened, Kevin McCarthy. 15 times he was rejected before he got that House speakership.
I think they've learned the lesson from that mess. Equity futures right now on the S&P near session highs by 0.8%. Coming up this hour, we'll catch up with Liz Young-Thomas of SoFi as stocks recover after a shaky start to 2025. The former New York Fed President Bill Dudley on what he calls the FOMC's communication problem, and Michael Gapen of Morgan Stanley as we count you down to the December payrolls report. We begin this hour with futures positive after snapping a 5-day losing streak to close out last week. Liz Young-Thomas of SoFi writing 2025 can be positive for business, albeit less room for runaway stock returns at these valuation levels and high earnings expectations. Reevaluate the opportunities for buying. There's plenty out there, not at all-time highs. Liz joins us now for more. Liz, good morning and Happy New Year. Let's talk about those opportunities elsewhere. Where are they?
Sure. Well, when you, when you look at the earnings picture for 2025, there are some pretty big reversals that are expected, and I think investors need to pay attention to that. we get so obsessed with this tech trade and focusing on whether or not we should be in a handful of tech names or all of tech or certain parts of tech. But the second best sector in the S&P for earnings growth is actually expected to be healthcare this year. And then you look at things like materials, industrials, that are going to see these big reversals from what their results were last year. So I think there are opportunities out there that are not trading at all-time highs.
How much are these opportunities torpedoed if yields don't necessarily come down?
Well, so the question about yields, we know that this 4.5% level on the 10-year has been really critical to the equity markets at large. You start getting to that 4.5% level, markets at large, indices at large start to struggle. When you're looking at the growth trade, so just a straightforward growth trade, that's what's going to get hit first and hardest, largely because a lot of those multiples have expanded so much over the last 2 years. But also because when you just think about the discount rate, this is rational for markets. As yields rise, the discount rate rises, which means that what you're willing to pay for a stock today is lower than what it would be if that discount rate was lower. So yields should put pressure on some of those growth names. That being said, I think investors are going to start looking for opportunities, growth opportunities in different places. And some of those places might be pharma and biotech. Healthcare really lagged the index last year. There's a lot of bad news priced in, bad expectations priced into healthcare right now. I think they're priced for a good opportunity in 25 if investors need other growth options.
Liz, when you talk to investors, how receptive are they to this message? Or basically, you've either had big tech that have continued to outperform, or people are getting a little bit nervous that everything has just gotten a little bit elevated and want to hide out in T-bills. I mean, how much are people willing to sort of look into the nuance at a time where some people are worried about peak sentiment?
Well, I think peak sentiment probably happened post-election, and we baked in a lot of this optimism, but without policy clarity. So now we've gotten to a more rational level. We've had this little pullback. We ended the year on a bumpy note. We sort of started the year on a bumpy note because we know that we need more clarity. We need more answers in order to actually trade those stocks for the long term. So how much are people looking into the nuance? I don't think so much yet, because we're in this waiting game between now and inauguration, now and when the cabinet goes in place, now and when we have actual clarity on some of these big policies. Also, when you look at a market that is so driven by momentum, people aren't looking at the nuances. We're looking at the momentum trade. We're looking at where sentiment is driving things. And a lot of times in those environments, you have this FOMO attitude, and that does ignore a lot of the nuances. So I think as time goes on, and if tech continues to come under some pressure, and if there is, perhaps a slowdown in earnings growth, a slowdown in the optimism, which doesn't necessarily mean a pullback, but just a slowdown in the optimism, investors will start to look outside and have to be more nuanced about it. I think profit margins and earnings are going to be a really critical factor in investing this year.
Liz, when you talk about policy clarity, have you gotten any clarity over the past 48 hours from Washington and Mar-a-Lago when it comes to the one big, beautiful bill and hopefully getting it done by May?
We've gotten a little, but as you guys mentioned earlier in the show, the market doesn't seem all that upset by it at this point. I don't think, first of all, it's a surprise to say that we're going to see more tariffs this year. I think we know that, but we still don't know exactly when that's going to happen, how much it's going to happen, and all the different places where it might actually impact markets. So again, it sort of just reinforces we're still in this waiting game. Things are proposals right now. They're not signed in. They're not affecting stocks at this point. Now, of course, as they become more and more realistic, the stock market will price that in ahead of time. But I think the message of today is that, okay, we know there's going to be more tariffs coming. Maybe the message is a little bit different than what we thought 2 weeks ago, but it's still tariffs and we're still not sure. So we have to wait a little bit longer.
Well, if it's still tariffs regardless, even if they're more narrow, is it now time for companies to potentially raise prices?
I don't think that companies are going to get away with raising prices as much as they have over the last few years, because consumers now realize that inflation has come down. It was easier to pass through those costs and those price increases when inflation was rising. wage growth was rising. Now we've got cooling wage growth. We've got CPI and PCE numbers that most people understand are at least at a lower level than they were. Certainly not deflationary, but at a lower level than they were. So it's more difficult to justify a pricing pass-through, even with a tariff change.
Liz, can you help us with the week ahead? We have $119 billion of debt auctions. We have the key labor report that comes out on Friday with the expectation of 160,000 jobs printed in December. And then we have the potential for truth postings or any other utterances around the Trump camp. Of those three, which are most important for you?
I'm focused on the jobs report. We also have JOLTS this week. So when you look at just what the market had been focused on through most of 2024, it was jobs. We had turned our focus to the jobs market because it seemed as if inflation had been largely defeated. Now we've got this environment where jobs are still very important. Inflation has again become very important. So this week, the story is going to be about jobs. I don't expect there to be any big surprises yet. I think what everybody is watching for is to make sure that we're still expanding the labor market. But one of the tenets of our 2025 outlook is that we have low churn in the labor market right now. And what I mean by that is low hiring, low quits, which means people just aren't moving around quite as much. So this idea of adding a ton of jobs every month, I don't think is something that investors are really looking for. What we're looking for is just no real deterioration in the labor market, because right now, as the Fed has mentioned, the labor market is still resilient and it's pretty well balanced. So what we need is for the labor market to stay stable while the rest of some of these bumps in the road figure themselves out.
We will get a lot of labour market data this week, including JOLTS data tomorrow. Liz, appreciate your time. It's good to see you. Liz Young-Thomas there of SoFi. Looking at the FX market, can't look away from it. 5 weeks of dollar strength, 5 weeks of euro weakness. That's the longest run of euro weakness going back to February of last year. That is not how we start this week. We bounce. Euro dollar up by more than 1%. Euro dollar 104. That Washington Post story really kicking around the US dollar this morning.
Yeah, pointing to the idea of maybe a more targeted approach on tariffs and maybe the sense that Europe would be spared at least even the really significant headlines that some people were worried about with the opening salvos of tariff talk.
Equity's doing better as well this morning. Equity futures up across the board with an update on stories elsewhere. With your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Some details from that report from the Washington Post. It suggests that President-elect Donald Trump is exploring a universal tariff, but would only cover critical imports. 3 people familiar with the matter told the Post that Trump's aides are still discussing the plan to impose the duties on every country. It would, though, be a paring back of the most sweeping plans from Trump's 2024 presidential campaign, where you'll recall he called for tariffs as high as 10 to 20% on everything imported to the U.S. Prime Minister Justin Trudeau is said to be preparing to announce his resignation. The Globe and Mail newspaper said the announcement could come as early as today. It would trigger a race for the party leadership, the winner becoming prime minister. Trudeau has been under pressure from his lawmakers and his party to quit for months. Scrutiny grew last month after his finance minister, Chrystia Freeland, quit. And at the Golden Globes, The Brutalist and Amelia Perez were the night's big winners after taking home Best Picture awards for drama and comedy. The Brutalist star Adrian Brody also winning Best Actor for his performance in the movie, and Brazilian actress Fernanda Torres winning Best Actress for her role in I'm Still Here. In the TV awards, FX's and John's favorite, Shogun, cleaned up, winning Best Lead and Supporting Actor, Best Actress, and Best Series. And that's your brief, John.
Danny, thank you. Shogun deserved to win it all. And I apologise to regular viewers of Bloomberg Surveillance who might have wanted to watch Shogun and had the ending ruined by Bramo a number of months ago.
Really? That's what this came down to?
I'm not sure
Congratulations
they're viewers anymore.
to them for a record showing at last night's awards
ceremony. I'm not sure
ceremony.
they're viewers anymore.
Okay, that's
great. I think they abandoned us after you ruined the show for them. Up next, the morning calls, plus former New York Fed President Bill Dudley on the Fed's communication problem. That's next. You're watching Bloomberg TV. Payrolls on Friday. The estimate in our survey, 160. This from Andrew Hollenhorst of Citi. Just publishing 120,000. That's what they're looking for, 120. And the unemployment rate rising to 4.4% in our projections for December should remind markets that the labour market has not stabilised and is continuing to soften. Goes on to say risks are balanced to an even softer reading than that. This, I think, plays into what we heard from Priya Misra of JP Morgan just last week on this programme. If you missed that, this was the line that stood out. Risks are asymmetric into payrolls this week. Slightly weaker report, and March cut will be back on the table. And we mentioned this, Lisa, back on the table pretty quickly.
Basically, the idea here is if you get a downside surprise, it's going to have a bigger reaction in the bond market, a rally, a bid into the market as people reassess just how aggressive the Fed might have to be.
Got a rally right now in the equity market, up by 0.75% on the S&P 500. A rally here across the board to kick off the first full trading week of 2025. Let's get you some morning calls. First up, TD Cowen raising its price target on American Airlines to a street high 25, citing improved pricing and a return of business travel. That stock is up by 4.5% in early trading. Your second call from Barclays, upgrading Boeing to overweight, seeing new momentum for production and deliveries. That stock is up another 1.8%. And finally, Stifel raising its price target on Tesla to $492, citing full self-driving and cybercab initiatives as catalysts. That stock is up by more than 2%. Let's turn to the Federal Reserve. Traders looking ahead to the Fed minutes this week and a rate decision at the end of the month. The former New York Fed President, Bill Dudley, calling for the central bank to improve its communication, writing, the better the quality of the Fed's communication, the more accurately market participants can assess how policy is likely to change. This tightens the linkage between monetary policy actions and financial conditions, which increases the speed and precision of monetary policy transmission. Bill joins us now for more. Bill, welcome to the show, sir, and a very happy new year to you. Where do you think the Fed is struggling to communicate right now? On what issue specifically?
I think the summary of economic projections last month was confusing to people because there was a pretty big upward revision to the inflation estimates for 2025. Yet it was hard for Powell to explain the sources of that. He noted that the participants don't operate from a common set of assumptions. Some were assuming effects of Trump tariff and deportation policies, some weren't, and some didn't say whether they were or weren't. So each of the projections has a different set of assumptions embedded in it, which makes it very hard to anticipate what the Fed thinks is going to happen and how they're going to react to it.
Bill, is the issue for the Fed right now communication or just not necessarily understanding which direction this economy is going to go in?
Both. I think the problem is they're having trouble communicating how they're likely to react to the Trump policies. Obviously, if tariffs are broad-based, that is one effect. If they're much more targeted, as the Washington Post report suggests, that has a different implication. So there's a lot of uncertainty about what Trump policies are going to be. And of course, the Fed is, uncertain about how the economy itself is going to perform. A key issue for the Fed in terms of the economy is the labor market going to continue to weaken or not? Powell has been very clear that he thinks the labor market is still weakening and he doesn't want it to weaken any further. So that's why Friday's payroll employment report is so important.
When you talk about a reaction function, this has been one of the big quagmires for people. What is sort of the scenario analysis that the Fed is doing and how they're going to respond to it? Do you think that they have that scenario analysis, or do you think that increasingly by default it is becoming an increasingly data point dependent Federal Reserve?
Well, there's definitely scenario analysis that takes place before each meeting. The staff prepares what's so-called teal book. And in the teal book, there's a baseline forecast, but there's also these alternative simulations, which suggest how the economy might evolve if things happen differently. I think that's another problem with the summary of economic projections. It's a modal forecast. It doesn't talk at all about what could happen if things turn out differently than what Fed officials expect. So I think one thing the Fed could do is actually do what a lot of foreign central banks do, is actually have a consensus forecast. Difficult to do with a committee with 19 people spread all over the country, but you could actually start to publish the staff forecast. There is a staff forecast available before every meeting, and if you put that out there, you'd have a better sense of, what the baseline assumptions of the Fed are.
But Bill, isn't one of the issues that comms problems is because they don't want to or can't be seen talking about policy? Do you just think the Fed should be more open about policy, all of the members?
Well, clearly what happens on tariffs and deportation is going to have a big effect on the economy in 2025. So I don't think you can avoid, thinking about that in terms of making your economic forecast. I think the Fed is reluctant to talk about it because he doesn't want to get itself engaged into this political discussion. And I think they're worried that will politicize the Fed. So they're trying to think about it without talking about it at the same time.
Is your main concern right now with the Fed communications, or would you do anything differently on policy?
I think they are in a pretty good place right now. I think that they understand that the economy is doing okay. Inflation is a little bit sticky, so it makes sense to wait. They also understand that there's a lot of uncertainty about what policy is going to be forthcoming. And Powell said when things are uncertain, you should slow down. So I think that all makes a lot of sense. I think the big disconnect, I think, between markets and the Fed is where is the Fed heading over the medium to longer term? The Fed says we're heading to 3% federal funds rate. The market says we're heading to something more like a 4% federal fund rate. So there's a pretty big gap about what is a neutral monetary policy. Fed thinks the neutral monetary policy is quite a bit easier than we are today. The market thinks that a neutral monetary policy is slightly easier than where we are today.
But what did you do with your own forecast when you had Trump coming in volume one? How did you change things? Did you anticipate the changes to policy beforehand or react once it was introduced?
I think I thought that there was more risk in the forecast. So I think the biggest change for me was to talk about risk and uncertainty going up. And I think that's what's happened today. I mean, I think the big transition from Biden to Trump is under Biden, we sort of knew exactly what the policies were. And in fact, over the last 2 years, there hasn't really been much in terms of new policy initiatives. Now we're going into the Trump era, and we know there's going to be a lot of changes in policy, and we don't know yet what they're going to be. So I think we're going from a period of low uncertainty to much higher uncertainty. And that's what's got to get priced into markets. That's one reason why I think the bond market has done poorly over the last few months.
Bill, appreciate your time. As always, Bill Dudley there, the former New York Fed president, looking out to 2025 and beyond. I think today's a great example of that. You know, the market gets to mark-to-market every single day. All this information, the Federal Reserve gets together and every 2 meetings has to put out some forecasts. And there is a big amount of uncertainty around changing policy from the incoming administration, good or bad, depending on what your opinion is. But this morning's a great example. You get the Washington Post. There's a take that maybe the incoming administration dilutes some of the universal tariff efforts we talked about at the campaign trail. All of a sudden, equities rallied by 0.75%. We're ripping in Europe, by the way. The DAX off to the races, euro stronger, bid at the front end of the bond curve, yields down. That's reflecting maybe a Federal Reserve that gets to ease just a little bit more because they don't have to worry about inflation so much off the back of the tariffs. This story could change again in 10 minutes' time.
So how does the Fed respond to this? How do they come out with some sort of reaction function at a time where essentially a lot of things could be changing? And if they want to have some sort of strategic communication, how are they strategic at a time when people do not agree? You have Andrew Hollenhorst talking about a labor market that's falling off, and you have Dan Greenhaus talking about stability. Guys, it's all just fine. Put those things together. Is it a communication issue or just a lack of clarity right now?
Well, according to Bill Dudley, when it's a lot of questions, and to Jonathan's point, can change every 10 minutes. You slow down when there's policy uncertainty. And if you have Speaker Johnson putting out the timeline basically for May to get this one big, beautiful bill, if you're the Fed, would you just stay on the sidelines until you actually see that policy become reality?
What Bill's getting to, the post-GFC communication apparatus is no longer valid in this world. It doesn't help. In fact, it hinders. And I think you see that again. Introducing staff forecasts, I think, making them public would be a good idea. And getting rid of the individual members, which I think kind of makes it even more difficult for the chairman to sit there in a news conference and reflect a consensus that doesn't really exist on the committee.
How do we get a sense of their longer-term parameters and expectations so that the market can understand when they'll cut, why they'll cut, and how they'll interpret incoming information?
Up next, we'll get the views of Mike Gapen of Morgan Stanley and Greg Peters of PGIM. From New York, this is Bloomberg. "60 minutes away from the opening bell. We are just off session highs on the S&P 500, up here by 0.8%, up nicely on the Nasdaq 100, up by 1 full percentage point. With your morning movers, let's cross back over to Manus Cranley. Hey, Manus.
Jonathan, thank you. Magical moments of volatility and calls. Boeing, let's kick it off with that. We've got an upgrade to overweight for the first time since 2019. Barclays gets positive on the stock. Why? Basically, the balance sheet is in a better shape. They've got the capacity to ramp production. How much of the MAX will they get back to production this year? They're demonstrating as they go into 2025 a sustained positive momentum for production and deliveries. Uber, roll it over. All hail the buyback. Look, they had a $7 billion buyback program. This morning, they've accelerated $1.5 billion worth of a share repurchase program. We have considerable momentum. We're scaling our free cash flows significantly. These are the messages from Uber this morning. Returning meaningful capital to shareholders while investing in growth. Our stock is undervalued. But of course, all CEOs would probably say that. Our stock is undervalued relative to the strength of our business. Let's close it out with Barclays. This has just come on the tape. Barclays on Citigroup, I should say. Citigroup is at an inflection point. Good news for Jane Fraser. They go to overweight at Barclays on this stock. It is the lowest valuation. They look at price to book multiples. JP Morgan 2.5 times. Morgan Stanley trading at 3 times price to book. So there is more breadth in this stock on the upside because of the lower valuation that they have at the moment, despite being up 32% over the past year. So a big call from Barclays at an inflection point on this stock. Jonathan.
Manus, thank you, sir. Appreciate it. The opening bell about 60 minutes away. Before we move on, I just want to mention Europe again. Euro Stoxx 50 is up by 1.7% right now off the back of that story from the Washington Post indicating that perhaps there's a consideration of the incoming administration to dilute the tariff effort. Watch this space. We'll see if we get any pushback from the incoming president later on today. But you're really getting a sense of where the bigger moves will be if that's the course of action. And it's beyond the United States. Euro dollar's up by 1.2%. Euro strength, the biggest one-day move going back to November of 2023. So in more than a year. And Lisa, it just points again to the fact that for European assets, they're at the mercy of US policy right now in a major way.
You asked this question, do they have any control right now over the destiny, right? And you asked this question about the potential lack of leadership there. But earlier this morning, we also got German December harmonized CPI. Inflation came in hotter than expected in Germany. They can't catch a break, 2.9% versus the estimate of 2.6%. You would think that would negatively affect some of these assets, but it didn't matter because really these headlines from the Trump administration took the oxygen out of the room.
Stocks in Paris, France up 1.6%. The DAX in Frankfurt, Germany up by more than 1 full percentage point. Traders on this side of the Atlantic looking ahead to key data on the horizon. December payrolls coming on Friday. CPI following on the 15th. The Fed's first rate decision of the year at the end of the month. Michael Gapen of Morgan Stanley writing the Fed may be hawkish today, concerned about inflation persistence and policy uncertainty, but turn dovish tomorrow, particularly if these same policies weigh on economic activity and labour markets over time. Michael joins us now for more. Michael, good morning. I've said this to you a million times. Congratulations on the new seat.
Well, thank you very much. Happy to be here.
Happy New Year to you. Let's talk about the data you're expecting this week. What would it take? How low is the bar to change this story at the Federal Reserve and to get them talking about rate cuts and talk about rate cuts quickly?
Well, I think it's a combination of you probably need payrolls like below 150, right? Something at maybe below 140, and you probably need an uptick in the unemployment rate. And I'd say our forecast is on the edge of that. We're at 150 on the headline. We do think the unemployment rate ticks higher to 4.3. And honestly, there's like 4 components to this report that are really interesting for me. One is retail. Retail was down in November despite strong spending by households. We're looking for a snapback there. That happened last year. Some of the seasonality issues still persist. Second, construction payrolls. They were strong in September and August. They were basically flat in October. Is that a weather story, or is the housing market just stuck and we're not going to get payback there? Third, I'd say manufacturing. They're down 60,000 jobs over the last year. Auto's down about 25 over the last 4 months. So what's happening there? How persistent is that? So there's a lot of risks around this. And then finally, immigration. It did slow at the end of the third quarter into year end. We expect it to slow further. That should give us a weird mix over time of lower employment growth and lower unemployment. So there's a lot of cross currents. We think this will be a report that says, yeah, the labor market's cooled and it's stable, but there's kind of 4 or 5 risks building around the labor market right now.
I'm looking back, and this is going to be the final jobs report for 2024. The expectation is for 180,000 jobs being created every month. That's down from 604,000 back in 2021 when this was the rebound from the pandemic. What are the key linchpins to help you understand whether this is a cooling or whether this is something more pernicious?
Well, I think to feed into your prior conversations, it's all about the policy outlook, right? So that we feel comfortable in thinking fiscal and regulatory policies are probably a 2026 story. It'll take time for those to come to fruition. But trade and immigration are on the forefront. And both of those could have adverse effects on activity and labor markets. We'll have to see.
Which is the more important question here? The idea of trade and tariffs, which is certainly whipsawing markets today, or frankly, immigration and what gets passed in the first couple of months of the Trump administration?
I think markets would tell you tariffs and trade. And I think we would remind everyone that we think immigration's just as important, right? Jim Bianco was on earlier saying potential growth is running around 2.5. Completely agree, but a lot of that is an immigration story. So if you pull back some of this immigration, you get slower growth in trend hours, slower growth in the labor force, and potential growth can come down, right? That's not going to be a robust labor market. The labor market, we think, will have two flavors over the course of the year. Weaker employment growth, but a low unemployment rate. How do you take that signal and understand what to do with policy? So we would say both are important. The market, I think, is more focused on the near-term effects of tariffs.
We could see executive orders almost near term when it comes to immigration as well. Do you have a base case of what 2025 might mean for immigration?
We do. We have immigration slowing to about maybe 500,000 this year. I wouldn't say it's an overly, restrictive situation. We have it more kind of hitting in 2026. But that's a big slowdown from where we've been. And if you kind of look back to a slowdown in global migration during COVID is a proxy for where this could take us. That could easily take 50 to 75 basis points off of potential. So we do have things getting more restrictive.
When it comes to the trade story in this Washington Post, which we've been saying things are very, very early now in these kind of debates and discussions, and Trump is not even inaugurated yet. But if it is going to be potentially narrow and more targeted, does the Fed need to really be that concerned about the impact that can have on inflation?
Well, the answer, of course, is it depends on how narrow, how targeted. But so I think what you heard this morning is consistent with what we're thinking. We never really thought the true universal tariff was on the table. And I think what you're hearing is the direction of travel on this is to try and mitigate third country trade into the U.S. So if you target China and trade gets redirected, how do we set up tariffs to prevent that redirection? But I'd also note the article hinted and said essentially this would be step one. I'm not, we're not thinking that would be it. We have tariffs ramping up over the course of the year, kind of peaking in the fourth quarter. So this is broadly consistent with what we're looking for, some opening salvos, initial steps, and things that build in gradually over time, not one big bang effect from tariffs.
I'm not one to hype the Fed minutes, but I actually think the Fed minutes this week could be quite interesting on Wednesday. What are you looking for in them?
Well, what we would love to hear, and I think Bill Dudley alluded to, some baked in policies, some baked in higher uncertainty, some said nothing at all. Anything that would give you clarity in essentially how much was baked in and what. Was it tariffs? Was it immigration? Was it fiscal? I don't think we're really going to get much clarity around that, but that would be.
They get to massage the Fed minutes just a little bit.
A little bit.
Do you think this could make things better or worse when they come out on Wednesday? Because a lot of people walked away from the previous Fed meeting and that news conference pretty confused.
Well, I don't think the minutes are going to help that situation a lot. If roughly a third put something in, roughly a third didn't, and a third didn't say anything, I'm not sure how the minutes clear that up.
Maybe they give us the breakdown of just how many people chose to incorporate it and how many people chose not to.
Yeah, maybe they'll give us a sense of exactly who it was, and maybe they'll give us absolutely nothing.
Name them.
To your point, though, to be completely honest, it could be interesting because they massage the minutes. Do they get more hawkish? Are they taking the signal from the long end of the yield curve as something more negative? And that, I think, is something to look for.
Wednesday, one to watch. Mike, good to see you.
Good to see you.
We'll do it again soon. Michael Gapen there of Morgan Stanley. Mike McKee's with us now, Bloomberg economics and policy correspondent. Mike, this week stacked, full of data and those Fed minutes on Wednesday. What are you looking for?
Well, it's always the first week of the month that gets everybody's attention on Wall Street, and we're looking for a lot of potentially market-moving data coming in as people try to figure out what's going on with the labor market, because we get all the precursors to jobs on Friday with ADP coming out and the jobless claims numbers. Those will be released on Wednesday because of the Thursday memorial service for former President Carter. We also have seen that the auctions, Treasury auctions, rescheduled into Wednesday and Tuesday because of that Carter funeral situation. So you're going to have a lot of early data coming in that people will be looking at to see where we're set up for. But then Friday, because of Thursday's a day off, Friday's going to be a big day. It's all the focus of the week. By the end of the week we get there, everybody's going to be looking at that.
Michael McKee, looking forward to it. 160 is the estimate in our survey. The previous number was 227. This is a take from Greg Peters of PGIM Fixed Income. This is what he's got to say. The global economy will grow at the same rate as in 2024. The US economy is doing quite well. The biggest risk is a resurgence of inflation. If inflation rises, we could return to the environment of 2022. You'll recall, of course, that 2022 was bad for both stocks and for bonds. Greg joins us now for more. Greg, let's talk about that big risk, and welcome to the programme, and of course a Happy New Year. What underpins that risk for you? Where would that resurgence of inflation come from?
Yeah, so I mean, it's not a base case, by the way, Jonathan. But it is a risk, though. And so just, looking at the pace of inflation, it seems to have moderated for sure. You're seeing the housing market still showing signs of inflation. The labor market's still quite healthy. So the seeds are there. Am I expecting kind of resurgence like we saw, back in 2022? Not necessarily, but the fact remains the market has really leaned into this disinflationary camp. So any movement away from that, I think, is a shock to the system.
Greg, given that, are you staying away from Tuesday's $39 billion of 10-year notes being auctioned off and the $22 billion of 30-year notes being sold on Wednesday?
Well, that's part of the self-fulfilling problem, right, Lisa? You have a tremendous amount of debt hitting the marketplace. The supply just keeps coming and coming. I think all else equal, that puts pressure on the curve, puts pressure on rates. And so you have that coupled with maybe inflation being a little more sticky or reversing, moving higher, that puts more pressure on the bond market. So, I think rates will be quite volatile and, if anything, a little higher than what people envision.
Greg, this seems like kind of a shift for you. You were more positive, more constructive on U.S. fixed income and even duration a couple of months ago. Am I right? What's changed?
Well, so I think some of the policy, items have changed. Our view all along has been a very wide, volatile range, which, professional fixed income manager doesn't like to have such a wide range. But I think that's the environment that we're in. We're spending so much time talking about policy. At the end of the day, we're investors, right? We look at fundamental data and we're being driven by these policy factors, which I think is, a much more difficult task. But we look at tariffs, we look at some other items, we look at the resiliency in the economy, and that probably points to more inflation, less Fed moves, and higher yields.
You're bearish on energy, and I have to ask, this is a priority for the incoming administration when it comes to, quote, drill, baby, drill, but also deregulation, which should make it easier for energy companies to do well. Why so bearish on the sector?
Well, so I think it's more of a factor, like how much more capacity is there, right? So drill, baby, drill. There's not a lot more that they can do. And so if anything, what drives energy prices is the global economy, China as well. And so we look the supply side, moderating, but then the demand side coming down as well. So I think that's the driving force. And it's important to remember, this was a narrative back in 2016 as there was all this hype and excitement around the energy sector, and it was the worst performing sector. So, just be kind of a little skeptical, cynical around some of those policy initiatives and how it translates into sector performance.
Which sector do you think is going to benefit the most under the incoming administration?
It's hard to say. There's so many moving parts, of course, but one area that we continue to be focused on is the financial sector. Less regulation on the margin, is quite helpful, but fundamentals are really quite strong. And so, we think the, financial sector should continue to do quite well here.
Greg, I know it's not your base case, but if we did get a resurgence of inflation and a repeat of 22, and you, by the way, are not the only one who's raised the prospect of that. Torsten's Lock of Apollo wrote the same thing coming into 2025. What works? Where do you hide when stocks and bonds are both pretty dicey?
Yeah, nowhere. I mean, that's what makes it so scary, right? It's so challenging in an inflationary environment. That's what we relearned in 2022. But, what should do better is some of the commodity-based segments. But there is no real place to hide, which is why you're seeing, gold being so resilient, right? That is an asset that investors, rightly or wrongly, like to hide in those types of environments. So, I think the playbook, if in fact that base case does come, that risk to the base case does come to fruition, there's not a lot of places to hide from that.
Greg, good to see you back. Appreciate your time, sir. Greg Peters there of PGIM Fixed Income. Finishing there on gold. We spoke to Goldman last week. Goldman Sachs looking for gold to get back to what's 3K right now. Lisa, 26, 23.
Yeah, potentially an inflation hedge, as well as the fact that central banks have been buying so much gold. So you put those two ideas together, and the fact that, the sheen off of Bitcoin seems to have worn off. I do wonder whether you still call that digital gold or whether people are actually going back to the physical commodity and whether that's going to be the breakdown this year.
Not to dodge that, just recall the conversation we had with Goldman last week. It was like every single issue was buy gold, geopolitics, buy gold, inflation, buy gold, debt dynamics, buy gold.
Which is a reason why pretty much everyone who we talk to is a gold bug. And it makes me wonder about the gold bars that are being sold at Walmarts and whether they're flying off the shelves.
Costco did quite well, right?
Costco, yeah. Well, I imagine a lot of people, especially if they're, what are they called again?
They had to put a limit on them. You can only buy so many per person.
I think it's just preppers. It's not just preppers. Buy gold.
How many gold bars do you have?
I'm not sure we could get into how many gold bars I've got.
For security reasons?
For security reasons.
Obviously.
Yeah.
Not that I walk around. Disclosure reasons.
Not that I walk around with gold bars. And what those South African coins called? Cougarans from back in the day.
Well, if
people used to collect them too.
Yeah, I have like a sack.
A lot of people
treasure.
bought gold in 2024. Yeah. Let's move on. I don't carry gold. Don't bother me on the street. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President-elect Donald Trump has weighed in on this morning's news that Nippon Steel and U.S. Steel filed 2 lawsuits to remedy the, quote, interference with Nippon's acquisition. Trump writing on Truth Social. Why would they want to sell U.S. Steel now when tariffs will make it much more profitable and valuable company? Wouldn't it be nice to have U.S. Steel, once the greatest company in the world, lead the charge towards greatness again? It can all happen very quickly. Elsewhere, it's the first full workday where the New York City congestion pricing program takes effect. It's the first such program in the U.S. 1,400 cameras and easy pass detectors were switched on Sunday to catch every vehicle traveling south of 60th Street and to hit them with a new $9 toll during peak travel times. It's part of the plan to bring $15 billion to the MTA to upgrade subways and mass transit. And the NFL playoff picture is set. In the AFC, the Bills will host the Broncos. The Steelers will head to Baltimore to take on the Ravens. And the Texans and Chargers will face off in Houston. The Chiefs have a first-round bye as the #1 seed. In the NFC, the Packers head to Philly to play the Eagles. Commanders rookie Jaden Daniels will face off against Baker Mayfield and the Bucs. The Rams and Vikings rounding out the matchup. The Lions secured the NFC's #1 seed, guaranteeing home field advantage throughout the playoffs. And that's your brief. John.
Danny, thank you. Appreciate the update and thanks for this morning. Up next on the programme, we'll set you up for the day ahead and we'll catch up with Tyler Kendall down in the nation's capital of Washington, D.C. from New York. You're watching Bloomberg TV. Stocks rallying going into the opening bell. The opening bell about 37 minutes away. Equities up by 0.8%. Your trading diary for the second week of the year and the first full week of trading for 2025 looks like this. Today, US PMIs at 9:45 Eastern, then durable goods at 10. Tuesday, JOLTS data plus ISM services on Wednesday, ADP payrolls and Fed minutes. On Thursday, you'll get another round of jobless claims, and on Friday, we will get the payrolls report. Let's turn back to Washington, shall we, and catch up with Bloomberg's Tyler Kendall with the latest on tariffs expected from President-elect Donald Trump. Tyler, welcome to the program. We've got a whole lot to talk about. We've got this one big bill potentially passed by April, May. On the one hand, we've got that effort, and then you've got the trade story. What do you make of the Washington Post reporting this morning, and what are people in D.C. saying about it?
Right, of course. So this reporting is saying that he's considering this, paring back what was a campaign promise for President-elect Trump that he would impose universal tariffs across the board up to 10 to 20%. Here in Washington, I think the reaction would be that it's really maybe working towards appeasing to some Republicans who had previously expressed concerns with President-elect Trump's tariff plans. Think Midwest Republicans such as Mike Rounds or even Senator John Thune, the incoming Senate Majority Leader. He had expressed concerns with Trump's tariff policies, and that was actually one of the sticking points when he was trying to become Senate Majority Leader and didn't outright get President-elect Trump's backing. Because when you look at South Dakota, for example, one of their biggest sectors is, of course, agriculture, and many of these Midwestern Republicans had expressed skepticism of what a potential Trump universal tariff plan could mean for their constituents and also their popularity on the ground.
Tons of debate, Tyler, when it comes to the sequencing of how all this would get done, and a massive debate in Congress on whether or not there be one reconciliation bill or two. President-elect is saying there's going to be one. Is the thinking behind this is that you have to cast a wide enough net to make sure that you can get every vote possible?
Right, exactly. So the key part in a reconciliation package is that it needs the simple majority to get through, which means Republicans can plow ahead with this without any Democratic support, but they're going to likely need every single Republican on board. We know that House Republicans actually stayed in D.C., partly because there's a huge snowstorm outside ahead of certifying the Electoral College results today, but also because Mike Johnson, once he won that speakership, said that he needed to go out and start to get all the viewpoints from his respective members, since we know that President-elect Trump wants to see this done as quickly as possible. President-elect Trump had already laid out that he wanted energy, immigration, and tax cuts to be the first three priorities that he accomplishes. This reconciliation package is going to give it all in one punch. Whether or not, though, that Republicans can solve those fissures within their own party, particularly when it comes to spending cuts to offset those tax cuts, remains to be seen, but it's something that they're already starting to discuss.
Tyler, thanks for braving the snowstorm for us this morning. We appreciate it. Tyler Kendall down in Washington, D.C. from the nation's capital. A big effort there. That Washington Post story really shaking up this market across fixed income, foreign exchange, and equities as well.
The idea of just simply tailored or pared back tariffs having a huge boost to some countries. I'm thinking about some in Europe as well as in Mexico. Whether it sticks like the snow, we shall see.
Let's see where we are this time tomorrow morning. This could change a lot. Coming up tomorrow, Julian Emanuel of Evercore, Torsten Slock of Apollo, Jason Thomas of Carlisle, Dana Peterson of the Conference Board. An absolutely stacked show tomorrow morning. Looking forward to having you join us. From New York, thank you for choosing Bloomberg TV. Brave the snowstorm. I hope you're all okay. Stay safe, and we'll see you tomorrow morning. This was Bloomberg Surveillance.